aggregate profits look great, but it's really just a couple of sectors that are driving it.
Sentiment did get a little bit dented around large cap tech earnings.
Some of that negative correlation to equities is coming back.
Our view is that a soft landing backdrop is good for a broad swath of companies.
I think this is more of an unwind than a momentum flush. The low volatility period is behind us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Now, this was a week to remember. This was a good week. Welcome back. Good morning. This is Bloomberg Surveillance. With stocks headed for a seventh day of gains, we have just seen the biggest six-day rally in the U.S. in stocks since November 2022, with the S&P now just 2% below the all-time high reached last month. Whatever the opposite of a toxic brew is, that is currently what we're seeing right now. This is a Bloomberg Surveillance with Anne-Marie Hordern, Danny Berger, myself, and John Ferro should be back on Monday. That is what we're expecting. And honestly, Danny, to me, what it really highlights is how far we have come from the turmoil and uncertainty of last week to the Goldilocks of today.
It's so true. 8% higher than we were from the lows. I mean, you look back 6 months ago and strong data was this market's worst enemy. And now, to your point, we're 2% away from all-time highs. Bond markets, on the other hand, maybe I get hate for this, but they've just been pricing in nonsense this entire cycle, just swinging from one extreme to the rest. Rarely can we say this, but at least for now, it seems like equities were right on the strength of the economy and bond markets were too dour.
Maybe they were too dour, and yet they didn't actually get blown out of the water because, frankly, this is an environment where suddenly you can have equity returns that are coming in strong. You could have retail sales coming in at the hottest level going back to September of 2023. And the Fed is still expected to cut rates. And Anne-Marie, that is the difference that's creating this, as Jim Reed said, sun-kissed bullish August holiday.
Bank of America says, take a deep breath, everyone. But it's pretty incredible that within days, the market has been pricing in almost a hard landing to a soft landing, very data dependent. I think that was really shown yesterday in the retail sales. You still see this propensity from the U.S. consumer to spend, but Mike McKee highlighted what they're spending on potentially changing a little bit. They want to make sure they're getting those core goods, groceries, and less of discretionary items like clothing, which is why I'm interested to see how the University of Michigan comes in today. A lot of people say it's distorted by politics, but where is the sentiment right now for the American consumer?
And where is the sentiment right now for the Federal Reserve? Will they come through with what this market is hoping and expecting from them, given the fact that this economy is still chugging along? Here's what's on deck for the Federal Reserve next week is Jackson Hole. That will be maybe a time for real policy prognostications. We also get a jobs report September 6th, September 11th CPI, and then on September 18th, that Fed decision. So far, the rhetoric from the Federal Reserve officials, Danny, to me, has really highlighted that even the hawks are becoming doves.
And I think Alberto Muslim is a perfect example of this. He is newer to the Fed, of course, and was really, really hawkish just 2 months ago. 2 months ago, he was saying that he needed quarters of good data, not months, but quarters of good data. Now with just another month of good data, he sounds different. He's saying we might be nearing the time to adjust policy. And again, it's not, doves flying out. We're definitely going to cut, but it's notable for him.
This is maybe when doves fly. There is this issue right now. Well, I'm going to be in Jackson Hole. I'm looking forward to hearing whether a policy shift really is in the cards. Anne-Marie, you're heading to the DNC. And frankly, to me, this is when suddenly the narrative ping pong that we've been witnessing in markets shifts to very much the political sort of march to November.
Right. And the political rhetoric coming out of both camps is drilling down on the issues Americans have been caring about for months. And that's the economy. You saw that yesterday when Trump was trying to stay on message that a lot of people have asked him to within his campaign. He struggled a little bit, but I thought it was more interesting the optics of it. He stood in front of groceries because while Democrats are trying to show that, yes, the inflation rate is coming down, the rate of inflation is slowing. But the fact is American consumers are not feeling it because prices have not dropped. So that's to one camp they're trying to highlight. The DNC is all going to be about affordability as well. We'll see that today with Kamala Harris kicking off really her economic policy. And today is about housing, which makes sense because we have housing data as well at 8:30.
We do have housing data followed by University of Michigan sentiment. Right now in markets, you could see potentially a seventh straight day of gains as potentially people look for this ongoing sun-kissed August holiday, as Jim Reed put it, 55.69 on the S&P, just basically close to flat. The euro dollar also just kind of meandering just south of that 110 place. And yields really, and this to me, I mean, and Danny, you were mentioning this, they might have been trading on their own universe universe, but that universe looks like it's fine in terms of expected rate cuts, in addition to the strength that we're seeing in the economy. Whether they'll be proven to be right, we shall see. We'll get into that in just a second. Coming up this hour, we've got John Stoltzfus of Oppenheimer as equities rally on a stronger U.S. consumer. Bloomberg's Josh Wingrove as Vice President Kamala Harris prepares to reveal her economic agenda, and Noel Dixon of State Street on growing market volatility. Let's begin with our top story. U.S. stocks looking to extend a 6-day rally after economic data and earnings from Walmart eased fears of an incoming recession. John Stoltzfus of Oppenheimer doubling down on his bullish U.S. equities call, saying that as the U.S. central bank moves toward easier policy on greater confidence, that its efforts to put untoward levels of inflation in check have been or are near being met. John joins us now. John, thank you so much for being with us. I just want to get a sense from you what you make of this incredible rally that's the biggest going back to late 2022.
You know, what we've seen here, Lisa, I think is a lot of people mistrusting the Fed, jumping to conclusions on a lot of things, and then all of a sudden getting the gist of actually perhaps the Fed chair is talking the talk and walking the walk. And we think we've got a good situation here. Things are indeed getting better, even as some things remain poor or worsen in terms of just whether it's geopolitical stuff or questions as to the outcome of the election in November, or questions in the fact that, not every company is producing these great results. In aggregate, we see the S&P 500 delivering so far for the second quarter.
John, you've said in the past that this is not a Federal Reserve that needs to cut rates. Do you still think that they're going to cut rates close to 100 basis points, albeit that's come off some of the more extreme prognostications that have been baked into the market? But do you think that that is necessary given the strength?
I think the strength is more resilience rather than of a robust nature, and there's a big difference in the meaning of those words. And I think that the Fed at this point is likely to do a down payment in September of 25 bips ahead of the elections, and I don't think it risks a questioning of its independence politically by doing that. I think it recognizes the fact that we are seeing a slowing in the growth of inflation very clearly towards their 2% target, but not yet there. But they're considering now, and the Fed chair, as you mentioned a little bit earlier, has really mentioned that it's not just about inflation, it's about considering the unemployment number, in effect, and that full employment goal. So I look for 25 bips now in September, and very possible 225 bips, one in November and one in December after the election.
John, as we get there, you can see that the path there leads to really diverging fortunes among companies, even within the same sector. And obviously, the consumer sector is really the poster child for this, that you can have McDonald's with poor earnings, but Walmart with really strong earnings. In a time like this, how do you think about investing in individual stocks versus things like buying an entire sector?
Well, we like, Danny, when it comes to investing in modern times, we like an alpha beta approach. We like to say you got to be like a kid. You got to know your alpha beta. So you'll play the passive index, and then you'll also have some alpha picks. It's the old adage of, you may not, you have to hedge whether you're in the right pew, even if, or in the wrong pew, whether you're in the right church or not. That old adage. And so when we look at it, essentially, you have to allow for the fact that you get these lifts sometimes that are just carried by a few names in a sector. On the other hand, there are sectors where it really is the individual performance that matters. But the consumer discretionary, the big thing about that, it was worst performing sector at one point coming into this, and now better retail numbers all of a sudden remind people that the U.S. consumer is not to be pushed under the bus. They're resilient.
Yeah, it has been. And John, even with the resilience of the U.S., I know you're still looking to get meaningful exposure to international equities, too. This is something that so many people have called for, saying get rid of your home bias in the U.S., go abroad. But it's a trade that keeps getting smacked in the face every time we see data like we did yesterday about the strength of the U.S. So what makes abroad a playable equity strategy now?
Well, we have to think, you want meaningful exposure to the international developed markets as well as to the emerging markets. And within the emerging markets, recognize that a huge transition moving away from one country-centric supply chain is a big deal happening that'll benefit a lot of other countries around the world. But a recognition that the international investment for a U.S. investor, unhedged in terms of currency, is likely not to perform all that well until the dollar gets off its high perch. The dollar is on a high perch because we're doing better than its peer economies around the world at this point. And also the world remains a very uncertain place, which causes people to hug the dollar.
John, do you see a comeback of the carry trade?
Pardon?
Do you see a comeback of the carry trade?
Oh yeah, well it sure looks like it. If you look at the Bloomberg today, it looks like the hedgies are going back into it very quickly on the weaker yen. But we'd have to think that probably with not as much enthusiasm as they'd gone into that trade earlier, and probably looking to make an exit. But it adds to the potential for volatility in here going forward.
John, I also love to ask you something you mentioned earlier, which is that you think the Fed should go 25 basis points, partially because that would shield them from some political blowback. Are you saying 50 basis points would look political?
No, I'm just saying 50 bips looks kind of unnecessary at this point. But 25 shows that they recognize the lag effect in terms of change in monetary policy, or a move towards change in monetary policy. So 25 looks like the most prudent to us, with keeping in the pocket, another 25 bip potential in November and even another one in December as needed.
What are you going to be paying more attention to next week, John, just to sort of wrap this up? Is it going to be Jackson Hole or is it going to be the DNC?
I think it'll be both. I'm going to be watching both of those to see what the message is for the markets coming out of the DNC. And related to Jackson Hole, it's always a good one to get a view of the cognoscenti and the Fed, what they're thinking and the latest reaction by the market. So the big thing is here, the second quarter earnings season, which is winding down now, really coming close to the end of it, will fade into the rearview mirror. And then it's what have you done for me lately? And it'll be very dependent upon data and upon things coming out of what people are talking about that they're going to do if elected.
John Stoltzfus of Oppenheimer, thank you so much, as always. Wonderful to have you, and I hope that you finally can take vacation after this sun-kissed holiday of an August week. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Haque. Yahira.
Hi, Lisa. The largest U.S. maker of chip manufacturing equipment, Applied Materials, delivered an inline sales forecast, while third quarter results topped analyst estimates, with the company saying artificial intelligence was fueling demand. But investors had been hoping for a bigger payoff from AI spending, so shares are falling nearly 3% in the pre-market. Bloomberg has learned that Seagram heir Edgar Bronfman Jr. is close to making an offer for Paramount Global, setting off a potential bidding war for the entertainment company. Sources say Bronfman is weighing an offer for National Amusements, the controlling company of Paramount, as well as Paramount itself. Paramount had agreed to merge with Skydance back in July. And Typhoon Ampel is edging closer to Japan's main island, disrupting transport and triggering warnings of floods and landslides. Carriers, including Japan Airlines and ANA, have canceled around 90 flights, impacting more than 15,000 passengers. The weather agency is warning residents to stay indoors and be aware of water hazards, while companies are urging employees to return home early. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, Harris making her policy pitch.
No senior should have to choose between either filling their prescription or paying their rent. Together with Joe Biden, our president, we finally addressed the long-standing issue.
I have an incredible partner. The progress we made, she's going to make one hell of a president.
And up next, you're watching Bloomberg Surveillance.
Next week, Bloomberg is live at the Jackson Hole Economic Symposium, bringing you news and interviews with Fed leaders and other economic experts. Tune in for continuing coverage leading up to a special episode of Surveillance August 23rd at 9 a.m.
We will be swimming with the moose over in Jackson Hole to see whether they have potentially some sort of insights into monetary policy. Welcome back. This is Bloomberg Surveillance, not Bloomberg Moose Talk. And we are looking at a market that is poised for a seventh straight day of gains although actually giving up some of that. It has been the biggest six-day rally going back to 2022 at a time. And Danny, I think that you nailed this. A real question about whether the bond market is sending a different message or whether it's paving the way for this perfect Goldilocks.
I guess the confusing part about it is some people look at 50 basis points and saying, no, that's not like jumbo super accommodative cuts. That just gets us back to normal. So that could be an agreement with good economic data. But I think after a day like yesterday, when everything did come up roses, everything was strong, the market does have to do some serious repricing. And I think just given that, you could say if the labor market comes in strong next month with that data, maybe the bond market will just have to do this all over again.
One of the interesting things is people are not talking about the neutral rate anymore. Suddenly that looks a lot lower than it did, say, a month ago. We will not be focused on this next week. We will be focused very much on politics. Under surveillance this morning, Harris making her policy pitch.
Every senior in our nation should be able to live with security, stability, and dignity. No senior should have to choose between either filling their prescription or paying their rent. Together with Joe Biden, our president, we finally addressed the long-standing issue that for years was one of the biggest challenges on this subject.
I have an incredible partner. The progress we made, she's going to make one hell of a president.
Here's the latest. Vice President Kamala Harris set to roll out details of her economic policy at a rally later today in North Carolina. Harris will reportedly propose offering $25,000 to first-time homeowners and a federal ban on food and grocery price gouging. Bloomberg's Josh Wingrove joins us now. Josh, there have been some questions around a number of her policies. I want to start with price gouging because it kind of fell flat, certainly in the business community, initially when it was rolled out by Joe Biden. Now there are questions about where she's looking to really attack price gouging at a time where particularly grocery stores are either capping or lowering their prices.
Yeah, well, first of all, good morning. I don't like this talk about moose talk, and then you bring the biggest Canadian you can find in, you know.
Do you want to go for moose talk? We could do moose talk.
Continuity here, you know, yeah, for sure. She is rhetorically just hammering on this. I think, though, there's two ways to look at this. Number one, Harris was an attorney general in California. She has sort of that built into her bones, and we're seeing that with her call to go after price fixing. She's signaling that the FTC and other agencies are going to be just as beefy as or even more so as they have been under Joe Biden. So that is a big signal and is, in fact, maybe one of the biggest signals she's sending here. Harris is saying she will use the levers of government if she wants to crack down on what she sees as abuse or pursue cases of alleged abuse. And so I think that that's a big one. But more broadly, I mean, people have been begging, Democrats have been begging Joe Biden to talk about grocery prices and inflation more succinctly for months. And so Harris is really pivoting to that with this pitch and saying, look, we pin a lot of the blame on that. That also has the effect of transferring the blame away from the administration and the question of whether the government policy and fiscal policy have sort of fueled the inflation here in the U.S. So she's, kind of gets a good bang for her buck here by going after this at a time when I note voters just simply aren't blaming her as much for the economy as they did Biden. It's kind of this remarkable reset that she's benefiting from where she gets the benefits of some incumbency while also a little bit of distance from it.
Josh, I'm curious, though, why would they open up their economic plan with this idea of price gouging? The Washington Post, in an opinion piece, says when your opponent calls you a communist, maybe don't propose price controls. Doesn't this make Kamala Harris more vulnerable to Republican attacks?
I think it may. I mean, but the Republican attacks are probably coming anyway. I mean, we alluded earlier in the show to Trump's, press conference yesterday with the sort of groceries lined up on either side of him. This is what they're going to hit her on regardless. So I think Democrats think we've got to do something about it. But I'll say they've been going after this for years. So this is one of the weird moments we're in where Joe Biden might be standing off stage saying, we're already doing this, as she pledges to do something. For instance, in the meatpacking sector, that is one that the Biden administration has been going after, saying that concentration there has helped drive price increases and essentially profits rather than passing on any savings or moderation in the last couple of years to consumers. So I think that on the sort of broader question, will Kamala Harris, go after grocery chains for individual pricing? I think that might be a bridge a little too far. But I think clearly if you are, for instance, grocers trying to merge or, just looking at how far you can push prices without triggering some sort of federal action, Harris is trying to send a signal here. Everyone you talk to around her says that those days as an AG have really shaped her thinking on things.
Josh, she's also going to talk about an expansion of a program that Joe Biden unveiled during the State of the Union. And this is for basically anyone that's a first-time home buyer can get as much as $25,000 back to help them purchase that first home. Is this just all rhetoric, though? Because she cannot do that unless she has a Democratic House and a Democratic Senate along with her come January 20th.
The short answer is yes, absolutely. It's rhetoric for sure. But we are going into a tax talk year, right? The winners of this election, both the presidency and the houses of Congress, are going to get to rewrite the tax code because no one's going to sit there with the Trump tax code provisions expiring and do nothing, because then they get hit with presiding over a tax increase. So there will be a tax deal next year in Washington, or at least everyone expects there will be. Everything Kamala Harris is rolling out right now is essentially her starting position. And so she's talking about that housing funding that would, of course, be reliant on some sort of spending agreement, whether in the tax deal or otherwise. And I think that's the lens for a lot of the stuff that we expect her to roll out today. We don't, by the way, have full details yet on what she will say. And I'm not expecting dozens. One source said don't expect an 80-point plan, so I would just point that out. So I would not look for the fine print necessarily. But this is her starting point. This is where they think they're coming from. And one thing that's hanging in the air also is politicians make a lot of spending pledges in election campaigns. The deficit is not small, and neither Trump nor Harris are really talking much about it, about what they will do about it. We'll be watching today to see whether she nods to that. That'll be one of the big questions in these tax talks is does either party actually really think that this is an issue, or do they think the boring path is sustainable as it is, or even could stand a little more spending without revenue on the other side that, of course, Republican lawmakers tend to not be in favor of?
Josh, you also mentioned Donald Trump's press conference yesterday, which you and Anne-Marie both pointed to as having groceries behind him. He did have this point where he was asked about this idea that those in his team have told him, stop doing these personal attacks to Kamala Harris, which he said, I'm entitled to do those personal attacks. Josh, what does that tell us about where this Trump campaign is going as we head into the final months?
Yesterday was a really good display of the tension with all of Donald Trump's campaigns, which is on the one hand, what his campaign wants to talk about, which is the economy and groceries, and on the other hand, what Trump sort of riffs on when they just sort of let Donald Trump cook. And the latter is what we saw, I think, with that remark. We also saw it earlier in the week with him saying that we're here to talk about the economy, but I don't actually think that's the most important issue. They are trying to keep him on message. Republicans around him and just Republicans generally think the path to the presidency and to success in the congressional races is just hammering inflation over and over and over. This has been the case in so many other countries where incumbents are falling like flies over this question. People are so mad about grocery prices. But with Trump, it's a package deal. And if you want Trump, you're going to get all that comes with it. Democrats, for sure, have been celebrating the moments they've seen him on TV this week, thinking it gives them fodder. And we'll tell, of course, who is correct, but that is the tension right now. Trump is clearly grappling with the message. I should also quickly note some staff changes on his campaign yesterday, or at least additions to his campaign, which is not a signal of how he thinks that things are going well or whatever.
Josh Wingrove of Bloomberg, thank you so much, as always, for being with us. We look forward to the next time. Just for this, to that piece that you mentioned, that op-ed in the Washington Post, this statistic in there. A government report on Wednesday showed that grocery prices in July were up 1% from last year. Annual grocery price inflation has hovered around that level for the past 8 months.
The issue is the rate of inflation is coming down, but people are amending prices they paid for a few years ago. It's going to take a few years for psychology to have an effect.
Coming up, bumper harvest could lead to lower food prices. That conversation coming up next. What a week it has been. 6 straight days of gains that included the biggest rally in that period of time going back to November 2022. Welcome back. This is Bloomberg Surveillance. Right now, giving up maybe a little of those gains, but nothing pretty dramatic as you end a week light on data after a number of 1, 2, 3 punches that all pointed to resilience in the economy, yet still a path for the Fed to cut rates. S&P futures lower by less than 0.1%, 55.64. NASDAQ futures just marginally higher, but the Russell 2000, and maybe we talk about this more than its weight would suggest in terms of just how big the companies are. But Danny, it really highlights how this seems to be a perfect backdrop for so many people, for even some of the weaker companies out there.
It's so true because it's this idea that the economy is holding up, the consumer is doing really well, see Walmart, see the retail sales, and we're still going to get cuts. This is what you were talking about before, Lisa, that you can have this perfect storm in a really, a certain fairy tale character type economy, and still we are expecting cuts. And that's great for companies like small caps.
Is there something we should know that we can't mention the G word, Goldilocks?
I feel like we talk about her a lot.
I know, we do. So we should, introduce her pet fish, Juji. I don't know. Meanwhile, if you take a look at what's going on with respect to the bond market, you can see that kind of complacency being baked in that the Federal Reserve will be able to cut rates more significantly, even if the economy is resilient. 2-year yields, though, still hovering above 4%, 4.05%. You can see 10-year yields 3.88 and 30 years 4.15%. If you take a look, though, and Anne-Marie, you mentioned this earlier, so let's go there. If you take a look at what's going on with the yen, today you're seeing a little bit more yen strength, but yesterday a good deal of yen weakness, dollar strength, as people piled back into that yen carry trade. And we're going to get to that right now under surveillance this morning. Traders hopping back into that yen carry trade. According to data from foreign exchange broker ATFX Global Markets, shorts against the yen are climbing. The currency weakening alongside a rise in U.S. stocks thanks to easing recession fears. So out of the frying pan into the fire?
Well, I think the question is whether or not you're going to see another BOJ hike or not, an interest rate hike this year. I love how one portfolio manager put it. Really, people have pretty short memories. And that's what it feels like, because we were talking about the unwinding of this time last week. And now people are piling back in.
Another way that someone has said this, which I love, from Mark McCormick, saying that FX markets are serial monogamous. They can only concentrate on one thing at a time. And the thing we're concentrating on now is strong U.S. data. What happens when the next BOJ decision rolls around? And markets have been calm. Remember, the deputy governor, when he came out and said we wouldn't hike, it's because markets are not calm. Markets are pretty calm by all measures. FX volatility, it's down somewhere in its 5-year average. So this would allow the BOJ to hike again if they would. So what happens to all those carry trades that just reloaded thanks to the strong eco data?
Well, it raises this issue that we were talking about with Joyce Chang of JP Morgan, that basically it takes more than just 1 or 2 hiccup days to really unwind a lot of some of the overweights that we've seen in markets. Again, this is the reason why on Monday we were talking about potential volatility coming down the pike. And it turns out none of that transpired this week, even in the face of really potentially narrative shifting data. But this to me is the question. How much have we really changed from last week versus become just as vulnerable as we were then, with a significant portion of those overweights and carry trades still in play?
Or maybe it's this idea that the fact we could rebound so quickly means that we are resilient, means that you can put on those trades. And as long as you're just not looking at it on those days of volatility, that you'll be fine. Maybe this makes us, even more complacent in some ways.
Well, especially if we get the whole full-throttled, really Fed put that a lot of people are expecting next week. Meanwhile, we're also focusing on politics. Former President Donald Trump taking questions from the media looking to defend his economic record. The news conference is at his New Jersey golf club, coming ahead of Vice President Kamala Harris' speech on her economic policy later today. Trump adding he feels entitled to personal attacks against Harris. Without getting into all of the personal attacks, there's a real question about strategy right now, Anne-Marie, and whether this is actually playing with his base, whether this is actually garnering some sort of enthusiasm to voter booths, or whether this is really a president who wants to go, or a former president who wants to go it alone with his advisors kind of wringing their hands and having their head in their hands.
I think Josh put it well when he said this is the whole Trump package. If you're going to get the economic message, you're going to get also some of the rhetoric as well. He tried to stick to script in the beginning, and then he started really going after Kamala Harris with the insults. That's going to work for the base. But what you continuously hear from his advisors, which are also even in the airwaves on Fox News, talking about the fact that they wanted to stick to 2 things, the economy and immigration, That's how they're going to be able to expand past the base. If he's not able to do that, it's going to get more challenging.
And I'm sure there's some frustration that Kamala Harris and her campaign just gave him such low-hanging fruit for doing economic policies of things like stopping price gouging, stoking demand in the housing market. They could turn around and say to their base, look, this is what we told you to be worried about, that they're very liberal, that they're communist, to the point of that Washington Post op-ed. And instead, we're not getting that message from Trump.
Instead, and I'm wondering, Anne-Marie, and I'm curious from your vantage point, what further shakeups could happen in the Trump campaign when it's clear that there is some concern and there are a couple new advisors that just came in?
Yeah, they brought back people like Corey Lewandowski. Trump was asked about this yesterday. He said, no, I think my team is doing great, led by Susie Wiles, who's a lot of respect within the Republican Party. But to Josh Wingrove's point, when you're shaking up the campaign, it potentially feels like maybe messages are not landing.
Meanwhile, investors are looking to lower food prices as well as on the political front. This is one of the hot button issues. But this actually might be an area of easing inflation concerns. A Bloomberg Commodity Index for grains falling to a 4-year low as corn, soybeans and wheat prices drop on the prospect of bumper crop harvests. Kona Haque of ED&F Man joins us now. Kona, great to hear from you. Thank you for being with us. I want to start with just kind of the reality of the data on the ground, what we're seeing with food inflation, especially as price gouging starts to become a very political hot potato. How much has food inflation come down even without a bumper crop season?
They have come down. We've come a long way since the Ukraine invasion, when prices reached historical high levels. I think that was natural because obviously Russia and Ukraine are massive exporters of grains. But what happened was that you saw those high prices lead to an encouragement for farmers around the world to plant more. And that's what we're reaping now. We're seeing more acreage, more investment in their crops, and that's resulting in bumper harvests in Brazil, in the USA, in Europe. And now we're finally at a good, comfortable level of supply and inventories. That prices are finally coming down. So that's finally feeding through to the supermarkets.
What we're seeing is the likes of Kroger pledging $1 billion in price cuts in order to appease regulators in its tie-up with Albertsons. I'm just wondering how much this is trying to sort of smooth some of the political concerns and how much this is what we can expect from other companies as well, given the bumper crops and some of the other dynamics.
So there is definitely the price at the farm level. But then you have the whole supply chain. So you've got the freight, which actually remains pretty elevated. Then you've got the manufacturing costs of the refineries. So you've got the wages, you've got the to remain pretty high. So by the time it actually gets to the retail level, some of those big cost reductions have actually dissipated a little bit. So that's why at the retail level, yes, for sure, they've come down from 2 years ago, but they're going to be pretty sticky at these levels. It's not going to be easy to bring further down from these levels. And for the average person who's buying bread or pasta, what used to be half the price only 4 years ago still feels pretty elevated. So there's a psychological impact here as well, because it's not coming down fast enough. It's kind of staying at these levels because they've all been passed on now.
And hence you get proposals like from the Vice President Harris saying that she wants to stop price gouging. I'm wondering if there is policy like that, how it affects, if at all, the production side of the chain.
So the whole supply chain is going to have to take a bit of a hit there. So farmers are incentivized to always produce maximum yields, maximum acreage, as long as their costs of production are being are being hit. So I think they will always try to produce the most, but then their buyers will have to then give them a decent level of compensation, and then the shippers and all of that. So who's going to take the hit? You can't afford for the farmers to take a hit, because then you're just going to end up in the same cycle where they're going to produce a lower crop the following year, and you're going to end up with a whole cycle of low crops and tight supply-demand balances. So it's a tricky one. It's simple to say in theory, but actually in the supply chain, you need to realize who's going to take the hit. And for me, that's really not very clear cut. And I definitely think the farmers would not be happy if they were to take any cut, because today, the average US farmer, the price today is very close to their cost of production.
Kona, if I can just add another variable into this. China demand, just in terms of the consumer, has continually been weak. They're having issues there stimulating purchases. And I just wonder, when we think about changing Chinese tastes and as well as weaker demand, how that fits into the overall picture of soft commodities at the moment.
So China, in the last 2 decades, was accounting for about a third of all the growth in agricultural commodity demand. The latest FAO forecast suggests that percentage increase is now going to fall to less than a quarter, less 15%, in fact. So that's a huge decline. Why? It's because China's population is decelerating. It's slowing, in fact. There's not enough youth. That means consumption for meat, grains, restaurants, beverages, all of that is now slowing at a fairly alarming rate, to be honest. The only reason that they're still growing, if you like, is because they're so big in terms of absolute population, but that population growth is slowing. So we cannot rely on China as much as we did in the past. They are obviously very keen on proteins, so to the extent that some of these grains go and feed into animal, that will definitely continue to grow. But we now have to look at sort of South Asia and Southeast Asia for more demand growth. And I think China is there. They will continue to be there and trying to mop up any grains that they can at cheap levels. But I don't think we can rely on them on the kind of double-digit growth that we used to see in the past.
Kona, speaking of China, American farmers were in the middle of Trump's trade war. And now Trump is talking about 60% tariffs of imports coming from China if he is elected. Likely that would mean retaliation from Beijing. How much could that undermine American crops?
That's a huge, huge topic. And to a certain extent, the fact that China bought a fair amount this year is in anticipation of these tariffs coming in at the end of the year. So I think China is definitely stockpiling. Yes, prices are cheap, so China is doing the right thing by buying it where they're cheap, but they're definitely front-tailing the fact that there are potential tariffs ahead. So they will be looking to buy what they can now, and they're going to switch to other origins like Brazil or Russia eventually for a lot of their food needs. So for the US farmer, that is a question, that is an issue, and I think they're going to have to diversify and look for alternative outlets because China is no longer it's not going to be economically profitable for China to be importing at 60% plus tariffs. So they're going to have to look for alternative for sure.
Kona Haque of ED&F, man, thank you so much for being with us. Really appreciate it. Have a wonderful weekend. I will just say, so we're going to be focusing on politics next week. We're also going to be focusing on Jackson Hole and the latest out of the Fed. Bill Dudley, the former New York Fed president, just put out this piece on Bloomberg Opinion where he talked about 5 questions that he would like to see addressed in Fed Chair Jay Powell's speech, including: should monetary policy be more preemptive? Should it try to get ahead of cycles? As well as, should the inflation target be higher? You probably will be disappointed. We probably won't get any answers to those questions. But Danny, in particular about monetary policy being more preemptive, that's essentially what people are betting on right now in terms of market pricing.
But it's also a criticism that people have had of the Fed, that they don't have this framework, that they're not reading what the data might be in months to come. Instead, they're just being reactive on backwards-looking data. So we are all hopeful that the Fed will do this, that they'll have preemptive rate cuts, because after all, that is better than having to react to things. And that is some of the flavor you've gotten from recent Fed speak. Goolsbee said something along those lines, that we don't want to be too late. But generally, this has not been the Fed's framework. It has been data dependence, which often means you're reacting to data, again, that is backward-looking.
And another question that he has out there is, should the Fed change the inflation target to a range? Some of these questions are going to be really key. We probably won't get answers, but we'll keep asking them. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Haque. Yahira.
Hi, Lisa. UK retail sales bouncing back in July. Sales rose 0.5% after a revised drop of 0.9% in June. Summer discounts and the Euro 2024 football tournament helped to drive spending. Retail sales are still below where they were before the pandemic started in early 2020. More on that Kroger story Lisa mentioned. The company is planning to slash grocery prices by $1 billion if its merger with Albertsons goes through. That's double what it previously pledged to cut at Albertsons stores. Kroger agreed to acquire its rival Albertsons in October 2022. The nearly $25 billion merger is an effort by Kroger to compete against the likes of Amazon and Walmart. And Resorts World Las Vegas has been accused of catering to individuals with ties to organized crime. The Nevada Gaming Control Board has filed a complaint alleging that the property welcomes certain people with suspected or actual ties to illegal bookmaking and histories of federal felony convictions. Resorts World is owned by Malaysia-based Genting Group. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, swing state economics.
What I'm expecting to hear, Lisa, and hoping to hear, is that her agenda around the economy is going to be about opportunity. That in fact she understands that America is the land of opportunity and it gives everyone a chance to do the most.
That's coming up next, heading into the DNC next week. This is Bloomberg. Trying to make it a seventh straight day of gains after the biggest six-day rally going back to November 2022. Good morning. Welcome back. This is a very different morning than a week ago where we were looking at turmoil that we had not seen since the height of the pandemic. That is gone. Right now there is calm pretty much across the board, in particular in crude as people reassess just how much geopolitical risks will weigh in. Under surveillance this morning, heading over to the DNC swing state economics.
What I'm expecting to hear, Lisa, and hoping to hear, is that her agenda around the economy is going to be about opportunity. That in fact she understands that America is the land of opportunity and it gives everyone a chance to do the most. And that is exactly what drives this economy, what makes our capitalistic economy so strong. At the same time that I expect her to continue most of the policies of the Biden-Harris administration.
Here's the latest. Kamala Harris set to pitch her economic agenda in North Carolina this afternoon ahead of the DNC next week. Harris and Donald Trump both looking to put the economy front and center. Noel Dixon of State Street Global Markets warning, quote, this could turn out to be a race to the bottom as it relates to fiscal irresponsibility. I think it's difficult to see how there is not a floor under the long end of the U.S. curve, regardless of who wins. Make bond auctions great again. Noel joins us again now. Noel, thank you so much for being with us.
Sure.
I want to start there.
Yeah.
It seems like people have forgotten about this storyline, and it seems like it only gets reprised when there isn't a lot of other types of drama in the market. Why is it not just a convenient boogeyman to pull out when people don't seem to have that many worries?
Yeah, I feel like, right now the market is certainly focused on different elements that it's a lot coming at once. And I think right now the main focus is, or the concern is, both candidates seem to be wanting to embrace or add to the fiscal spending tab. And that is what I think most people are going to be focused on and keeping an eye out on. And it gives them trepidation about going fully into the bond market, especially into the long end. So from what we experience, it seems people are more focused on more the belly of the curve, staying on the short end of things. Because there's just a lot of uncertainty, and we're certainly going to get, I think, a risk premium baked in as we get into or approach the election.
Noel, when it comes to some of this rhetoric that's being thrown around, Kamala Harris today is going to talk about $25,000 if you're a new home buyer. Of course, you need Congress. So that feels like rhetoric. But Trump tax cuts are back in play. He's talking about a lower, his words, lower class, middle class, upper class tax cut across the board. Is anyone in these parties serious about ratcheting back fiscal spending?
I don't think so. I think right now, we've been able to sustain these high levels of debt, and they think, the music will continue to play. But I think, we're at a very different starting point. And this is what I think markets and investors are starting to get concerned about. We see it with some of the activity. And like I mentioned before, I think a lot of this risk is going to start to get baked in post-Labor Day. And I think we could expect some volatility.
To borrow a phrase from Lisa, are you expecting potentially a Liz Truss moment? Is that what it would take, the market to push back on the U.S. federal government?
I would say that's what it would take. I don't think we'll get to that extent, just to be fair. I think, we are still the reserve currency of the world. I think we still have very deep capital markets. However, I do think we have to expect that we're going to get some volatility leading into November.
I mean, it is pretty remarkable that we have everything you're saying. We've seen some bond auctions tail. The deficit's going to get worse. The economy isn't falling off a cliff, but 10-year yields are still below 4%.
That's right.
What is fair value to incorporate the fear of rising deficits in the U.S.?
Yeah, I think fair value is definitely higher than 4%. Right now, I think you have to juxtapose the fiscal concerns with what's going on with central banks. And there was, up until I would say yesterday, until we got retail sales, there was this concern that, the U.S. economy was starting to roll over. But as we see, the labor market is still tight. The U.S. economy is still relatively strong. So you have that environment. You augment that with some fiscal spending. And I think that's where you get above 4% and stay there.
Well, people have pointed to this idea that there's going to be less fiscal support than there was in the era of the CHIPS Act, the Inflation Reduction Act. Bank of America puts it at about a 5% drop in U.S. government spending year over year. How are you thinking about the U.S. fiscal impulse at this moment?
So the fiscal impulse, I think you have to keep in mind the CBO projections right now factor in the lapse of the Trump tax cuts. So both parties are going to keep, Trump obviously wants to keep it full stop. But, the Democrats, they're saying, 400,000 or below are going to keep the tax cuts. You add on to that, they both seem to be on consensus in terms of no taxes on tips. That's another tab. So you can start to see it start to add up. Like she mentioned before, Kamala Harris is talking about $25,000 tax credit. I know she wants to probably extend some of the tax credits that they had during the Biden's tenure. So all of that's adding up, and I think it's going to definitely, like I said, cause some volatility.
Just to sort of underscore this whole point, are you basically recommending to State Street clients not to go into long bonds?
I think I would be definitely skeptical to go into the long side right now of the curve. I think it's more secure to probably stay on the short end. And the Fed may cut rates. However, given how like I mentioned before, the economy is pretty strong, I think rates will, the Feds, they only could go so far.
Well, how far would long end yields have to back up for you to recommend them against clients?
I think they would have to get to 5% for me to feel comfortable recommending long end at this stage, and that's the 10-year.
And this is entirely because of political concerns, not because of what you're seeing with respect to potentially preemptive Fed cuts and just where inflation might be long term. This is having to do specifically with the deficit, correct?
It does, yeah. I think it's completely the fiscal situation that we find ourselves in, and I think it's just going to get exacerbated regardless of who wins.
How much pushback are you getting from clients?
I would say it's kind of mixed. I would say it's mixed. Some clients are, all in because their perspective is, global central banks are cutting rates, good environment to go into bonds. But some are starting to get concerned about some of the proposals that are getting floated around. I think they were caught off guard a little bit when Kamala embraced this, no taxes on tips, because that was something new. Now the thinking is, okay, what else could come to the fore? What else could be reintroduced here? So I think that'll, what she lays out later on today, what she kind of emphasizes during the DNC will be critical.
Noel Dixon, thank you so much for being with us. Really interesting. Noel Dixon of State Street at a time when we're heading into the DNC. And it seems like the biggest volatility, Emery, could come from the bond market, not the stock market.
Yeah, that's because of, to Noel's point, this political rhetoric and what rhetoric translates into policy. Remember, we're talking about also that the tax cuts are going to be a huge issue in 2025, but also we're on the fiscal cliff again. We're facing a debt ceiling debate next year, and the composition of Congress could potentially change the path for that.
I can just say, Denny, I just hear Steve Eisman's voice in my head. Oi, the deficit. Oi, the deficit. They've been wrong every time. I mean, at what point do you hear this increasingly from more people?
Maybe it is bond auctions. To your point, make bond auctions great again. Maybe when we actually see some bigger tails, something that looks like a failed auction, maybe then we start having to pay attention. But in the meantime, you can say, we just need to see the makeup of Congress. We need to see what they'll actually propose, and we can ignore it for now.
I love it. So just to give you a sense, we've got a 20-year auction coming next week. We also have a 30-year tips auction coming next week. Otherwise, we've got to wait a while for those other bigger auctions. Coming up next, Katerina Simonetti of Morgan Stanley, Wendy Schiller of Brown University, Ambassador John Bolton on Iran, and Winnie Cisar of CreditSights. This is Bloomberg.
The Fed has a real opportunity here to sort of shift the narrative.
What my read of the current data is that there's enough good going on to offset whatever the weakness is.
Unemployment could really accelerate higher if you're not careful.
There's scope to go more aggressively right now, just given the combination of data that we're seeing on inflation and also on the employment questions that lie ahead.
We're hearing all these cut talks, and it's overly optimistic, looking for 50 basis points per meeting through the end of the year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Fear and volatility melting into sunshine and roses. Welcome back. Good morning. This is Bloomberg Surveillance. Anne-Marie Hordern, Denny Berger. I'm Lisa Abramowitz. John returns on Monday. Today marks the transition point from earnings and data to the Fed and politics. Let's go to the Fed first. We've got Jackson Hole coming up next a week, which might be a time for them to indicate some sort of shift in policy. And then, honestly, we get the data that is going to be so important. Danny, how much are you looking to Jackson Hole versus the jobs report versus CPI?
Well, I think jobs report probably the most important, just given what happened last time. But in the meantime, you have this 2-week period that's still kind of summary, that you don't have a lot of data, and instead you have Jackson Hole. So that fills the void of the thing that could act as a catalyst for what? I'm not certain. If anything, it seems like Fed officials are coalescing around this idea that, to Bill Dudley's point in his op-ed this morning, that they want to be preemptive, that the risks have shifted, and the greater risk is going not soon enough versus cutting too soon.
How different a couple years makes. The Payne speech really sort of resounding through a lot of economists' minds still to this point, and we haven't seen that kind of pain. But Denny, to that point of preemptiveness, that is the challenge in markets that are welcoming the sunshine and roses of both a resilient economy and also a Federal Reserve that could cut by almost 100 basis points still as baked into markets.
And that's why you can get something that would be unimaginable a year ago. 2-year yields climbing 13 basis points and small cap stocks rallying. And they continue to rally this morning. And that is something you usually would say, okay, the bond market is backing off of cuts. Surely that has to be bad for small caps. But to your point, we're pricing in just this very thin needle being threaded, this idea that we get rate cuts, but it's an environment where economic growth is still holding up.
And it really shifts also to the political front. And I have to say, Noel Dixon was great in talking about why it matters so much, and maybe not to the stock market as much as to the bond market, when suddenly all the proposals that we're hearing about the economy include more spending or tax cuts, not necessarily fiscal discipline.
Not fiscal discipline from either side of the aisle. And we're going to get a lot of that today when we get Kamala Harris speaking in North Carolina, a swing state. She's going to talk about, those Americans that you continuously see in the polls and say, I can't get on the housing ladder. Yesterday was about inflation and grocery bills. Today is about housing. $25,000 is their proposal. Biden already pitched this, but it can't be done unless you get Congress on board. But what's interesting is this comes after we got data yesterday. Confidence among U.S. home builders slipped 4th straight month. This is the idea that we also heard from Home Depot, this deferral mindset that you see consumers and Americans in because they are waiting for the Fed to cut interest rates.
At the same time, for markets, there's sort of this question of how much politics matter. And you hear different things from different people. It shouldn't matter, it won't matter, and then they say it's the first question that every client asks them about. I just wonder, Danny, we're actually going to see that volatility. We have seen that volatility, what it would take to really spur some of these auction issues or some sort of real sense that maybe this time is different.
I think you can look at, again, under 4% 10-year yield and be a bit confused by it. Be confused because the data, it's not heading off of a cliff, and we have this huge fiscal spend likely to come from whoever is the president. As for what it takes, so far we've been taught that you can keep buying at auctions, you can keep loading up on duration, and everything will be okay. So we have that Pavlovian urge to keep buying it, and nothing is telling us else. But maybe you need something like last auction we saw where under 4% wasn't appealing. You have that plus deficit, and maybe that's what makes things go right. It's just like trying to find this weird mix and hoping someone pays attention.
Well, right now, if I'm paying attention, it's 3.87% on the 10-year yield, not north of 4% once again, even though Noel Dixon was talking about a potential 5% threshold that would entice him to buy. You're actually seeing yields lower today after yesterday's data, as well as just this general feeling that the Federal Reserve can keep cutting rates. The S&P looks like it is going to have a hard time eking out a 7th day of gains after the biggest 6-day rally going back to 2022. 52. We're looking at 55.63. We are just about 2% away from record highs on the S&P. Right now, what you are seeing in the currency space is quite interesting. A real question about whether the dollar can strengthen on the heels of what is expected to be a weakening cycle, even with a resilient economy, or whether we're going to see ongoing dollar weakness akin to what we saw in the past week and a half. Coming up this hour, Katerina Simonetti of Morgan Stanley with stocks on course for their strongest week of the year. Ambassador John Bolton as tensions simmer in the Middle East. And Winnie, Cisar of CreditSights amid signs of a resilient consumer. Let's begin with our top story. The S&P 500 looking for a seventh day of gains following strong U.S. data. Morgan Stanley's Katerina Simonetti writing this. The Fed might be behind the curve, and it is not priced into current equity multiples. While the data will determine the ultimate direction of the policy and the markets, the soft landing is still the most likely scenario. Katerina joins us now. Katerina, do you think that there is a tension right now between what bond markets and stock markets are telling us?
Well, absolutely. And when we look at in the large scheme of things at what this year has been like, we went from being solely focused on Fed and rates and inflation, and now it's all about the earnings and the economic slowdown and volatility. And it's very confusing for investors, and who tend to have sometimes, a bit of a short-term memory, because if anything, last couple of weeks showed us just how volatile stock market can be going into this pre-election stretch, and this is where, of course, we have to pay attention to earnings, data, forward-looking outlook, and making sure that our portfolios appropriately reflect our views.
Katerina, almost 90% of companies in the S&P 500 have already reported earnings. We're really quite through that period of time. We have to wait until the beginning of September to truly start getting data again on the economic front. Given that a lot of the information is in front of us, and we have already, to really analyze, how do you recommend playing some of the volatility that could come up?
Well, Lisa, it is very clear that, both consumer behavior and corporate earnings are affected by this high interest rate environment. And, inflation, while we are thrilled to see the CPI data come down, we know that this is also something that will, pretty drastically affect the pricing power for the companies. So while we look at the earnings data that is in front of us, that looks to be quite positive, as we look ahead at the second part of the year, we're not quite as optimistic. We're expecting a slowdown. And while we do believe that the soft landing is the most likely outcome, it is also, something that, that coincides with expectations for the rate cuts. And this is where, Federal Reserve has a big decision in front of them on timing and, of course, the extent of the cuts.
Concerns about margins, Katerina. Usually that's been used in the context about consumer-facing companies, of a consumer that we're increasingly learning is not falling apart, but certainly feels stretched. How does that work with staples? Staples being this kind of sector that you want to buy because it's acyclical, but at the same time, these consumer companies may be feeling the pain for margins.
Well, absolutely. That is a very big part of this equation, but we also have to look at it, in the context of this defensive play. What really changed the rules a bit, is this disproportional presence of the big tech exposure in most of the portfolios. And what we tell our clients is that they have to look at the consumer staples, at defensive plays, and, make sure that they have appropriate presence in, the areas of the market like the financials and healthcare and industrials. And despite of the margins and despite of the higher expenses, the area that we think will be most affected by it is consumer discretionary, which we currently have the underweight rating on, because we think that there are going to be parts of the economy that will be affected by these higher expenses and, by this environment more than others.
If we made a lot of noise about tech being overly expensive, Katerina, I wonder if it makes sense to talk about safety stocks being too expensive. Walmart trades at a 28 times price to earnings. That's more than Meta. That is more than Amazon. Is the price to safety, does it matter at this moment? Or in downturns, do you stop caring about valuations?
We never should stop caring about valuations. You make an excellent point, that we have to look at the broad context. And that's why the balance in the portfolios make all the is probably one of the most important aspects. We want to make sure that we don't lose track of the exposure we have in one area versus another. And this is the time, precisely because of these factors, that we favor individual stock picking versus the broad index investing. Because one company might be overvaluated, another one might be better positioned competitively in terms of the pricing power advantage. Just forward-looking outlook. So this is where, we might be looking at two very similar companies in favor of one versus another.
Katerina, I want to ask you about something you put in your note about the volatility surrounding elections. Historically, it's September, October, then it dissipates in November. But this is very unconventional, this election cycle. How are you thinking about that volatility, given the fact that we've already seen a number of twists and turns in the election cycle, and it's only August?
Of course. I mean, it seems like it started so much earlier. And even though this election seems to be, just so emotionally charged, if we look back historically, going into the election, generally we can expect the heightened volatility. So what we tell our clients is just to go into it with full expectations, be ready to buy on dips, just kind of, take a note of the policies that might be brought forward by each of the candidates, not to make any drastic portfolio changes. We think that it doesn't make sense to do it prior to knowing the outcome. But we think that it is time to definitely position ourselves for what next 4 years would be like once we know the outcome.
Has this been top of mind for your clients? Is the first question they ask you about?
Absolutely. This is the most phone calls that we get is about, the outlook next couple of months, but also portfolio positioning going forward, and how do we come out of the last couple of years where the growth was so disproportionately located in certain sectors. And when we look at weeks like today, where we have this, wonderful earnings and, market seems to be recovering and investors are getting a little bit of a relief after the correction we saw a few weeks ago, this is the opportunity to rebalance. This is the opportunity to take profits and to go into some of these defensive, maybe underrepresented sectors, that should be well balanced and present in portfolios.
I love it. So many people come on and they say, you know what? Politics, they don't really matter. Do clients ever ask you? It's always the first question they ask you. Katerina Simonetti of Morgan Stanley, thank you so much for being with us. I will just say that earlier this morning, we heard again from Austin Goolsbee on NPR talking about how the economy is strong, and yet if you see employment turn, it can turn very quickly. And it really goes to this question, Danny, of whether the Fed should act preemptively that Bill Dudley put out there this morning in a Bloomberg opinion piece.
Right, because employment, it's like the volleyball held underwater that once you let go, it kind of shoots up higher. But one of the issues is people keep looking at all these different signals of recession, saying they need to act preemptively because we see things like labor market weakness. We see things like the SOM roll being triggered, like the yield curve starting to uninvert, and therefore the Fed needs to act. Part of the problem is, and Sumaya Keynes of the FT gets into this in a column, and I think it's a really good point, there have only been 9 recessions since the 1990s. That's not enough data to have statistical significance in what usually happens into a recession. So we're using all these past indicators, but I think we can say this time might be different because it's always different. We haven't had enough data to really understand what these signals mean.
Which is essentially what Claudia Sahm is saying, to say her particular eponymous rule is important to consider, but not actually a rule. Right now, let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Yaira Haque. Yaira.
Hi, Lisa. Israel has begun talks with international mediators in Doha about a proposed pause to the war in Gaza. Qatar is hosting delegations from Israel, Egypt, and the U.S. to work on a 3-stage proposal. It aims to halt the fighting, free hostages held by Hamas in exchange for Palestinian prisoners, and transfer more aid to the ravaged Gaza Strip. Hamas representatives are not joining the talks. A new financial disclosure from Donald Trump shows $513 million in income from his U.S. resort and residential properties. That includes his well-known Mar-a-Lago and Bedminster clubs. The filings also reveal tens of millions of dollars of liabilities and debts linked to his legal troubles. Separately, Trump has raised about $635 million since launching his presidential campaign. And Hurricane Ernesto has escalated to a Category 2 storm as it heads to Bermuda. It's expected to become an even stronger Category 3 hurricane by this afternoon. The track currently shows Ernesto passing to the west of the island, but it could unleash heavy rain and flash floods on the territory and cause power outages. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the inflation blame game.
Harris has just declared that tackling inflation will be a day one priority for her. It's going to be day one. But day one, really, for Kamala was 3.5 years ago. Where has she been? And why hasn't she done it?
That's coming up next. This is Bloomberg Surveillance. We got the data, we got the sense of what's going on with companies, and it is all sunshine and roses, at least for markets over the past 6 days, which has been the biggest six-day rally going back to November 2022, struggling to make it a day seven with about a decline of 0.1%. And we're looking right now at yields, though, lower. And this is the interesting point. Even though stocks are quiet, bond yields continue to decline, even on the heels of a sign of a resilient U.S. economy. Under surveillance this morning, the inflation blame game.
If she wins, your finances and your country will never recover. You're never going to recover. The radical left person wants to put price controls all over the place, which will end up driving up your prices, not down your prices. Harris has just declared that tackling inflation will be a day one priority for her. It's going to be day one. But day one, really, for Kamala was 3.5 years ago. Where has she been? And why hasn't she done it?
Here's the latest. Donald Trump returning to Pennsylvania this weekend as he aims to regain ground in the presidential race. Trump's allies reportedly urging him to emphasize policy issues and hit the Harris campaign on the economy. The latest polling from Real Clear Politics shows Harris holding a 1-point lead ahead of next week's Democratic National Convention. Joining us now, I'm so pleased to say, is Wendy Schiller of the Taubman Center at Brown University. Wendy, great to see you. It's been too long. I want to start with what we've seen out of both proposals. Do we have a sense of what the Trump economic proposal actually looks like?
Well, Lisa, I mean, Trump was president of the United States and presided over an economy that was doing well until the COVID pandemic. So in some ways, Trump has less pressure to, sort of really delineate what he will do next, since voters, right now seem to fondly recall the state of the economy under his presidency. The pressure really is on Kamala Harris. And, even though I had heard that she wanted to impose price controls, that was new to me, that other line about where has she been for the last couple of years is going to be effective, because that is a very big concern to consumers right now. And if she's taking the Biden mantle, she has to take inflation with it.
Well, she's taking inflation with it, and she's trying to put the blame somewhere else, Wendy. I think that was the whole point of the price controls. It's not us. It's the corporation's fault. She's also going to come out today and talk about housing, $25,000 for first-time home buyers. President Joe Biden also talked about this in his State of the Union. Will that land with voters, even though she cannot unilaterally do that? She needs Congress support.
Yeah, Anne Marie, I think that's a pretty out there proposal on the part of the campaign, and I don't think it helps them with independent voters. So it's really this balance, and the reason is because I think a lot of people have mortgages, have already bought houses, and that those are a lot of suburban voters that they need. This is the constant balance for the Democrats, balancing getting their base out, young people who say they can't afford to buy a home, tackling student loan debt, and also making sure to bring those independent voters back into the Democratic fold, at least in public opinion surveying. And that's the balance. And I don't think that proposal will do anything with independent voters.
She also has to balance how much she campaigns with Joe Biden, given the fact that Americans blame him for what they perceive as higher inflation. We do know the rate has come down. How does she do that?
Well, Anne Marie, in 2020, a friend of mine said this is, good grandpa versus bad grandpa, depending on, who you liked and who you didn't like. So I don't see the great liability in, showing up with him once in a while, particularly in places where he's still popular. I think it says I'm respecting Joe Biden to the base that, that still liked Joe Biden. But you're right. I don't think that it should be the most frequent part of her appearances with the campaign. But there is still a slice of the Democratic base that that likes Joe Biden and believes in Joe Biden. So I still think it's a plus for them to keep doing it just for a little while longer.
And Wendy, so you described just there with Anne-Marie, her housing policy is out there. I actually wonder what you think of the nuts and bolts in it and the impact would be to have 3 million new housing units, to try to encourage that through tax incentives, and giving $25,000 to first-time homebuyers, about 1.4 million people. If she was able to pass that, I just wonder what you think the economic impact of such a policy would be.
Well, unless you find a place to cut, it's going to continue to blow a hole in the deficit. And, as we know, as the deficit grows, our public debt grows. So, this is something she'll have to explain. And independent voters do not want to see a major explosion of the debt or an expansion of the federal government spending. So this is really a problem. I mean, how are you going to pay for it? And that is a big question. And saying you're going to raise taxes on the wealthy or raise taxes on corporations, that doesn't usually work all that well for Democrats. So they may have to rethink how, walking that back. It's also the case that, not everybody wants housing in their backyard. We've seen that even in liberal blue states, a lot of NIMBYism. So you may want to build all that new housing, but where is it going to go? And how effective can you really be?
You say the voters might start to get concerned about the deficit. Wendy, for now, the markets are not concerned. Should they become, does this market have the ability to impact fiscal policy? Could rising bond yields make a Harris, a Trump, you name it, administration change their minds in some of the spending plans?
I think this is a turnout enthusiasm game from now until November. So, your very core base of the party has to get out the door. And I don't think that slice, either the Republicans or the Democrats, is going to, base their voting decision on the deficit. So I don't see a lot of impact there. And let's remember that, Congress is full of a lot of people who like to bring home money to their districts. So tackling the deficit is always a multidimensional and complex problem with lots of other political actors who don't really want to go back and say, yeah, I cut your spending.
There was a time when one party, traditionally the Republican Party, was thought of as the more business-friendly party. And I'm just wondering, as we're talking about the deficit expanding and some sort of more populist types of policies that are coming out of both parties, I'm wondering, with the economic plans that we're hearing, do you hear one party catering to business more than another?
Well, Lisa, as you all well know and talk about all the time, the economy and business is so globally intertwined now, so different from even when Bill Clinton ran in 1992, it's the economy, stupid. That was his big slogan. Now it's a very different ballgame to think about policies that will benefit corporations or benefit workers or consumers because it's so globally interdependent. And so that, to me, is, the problem with being, corporate friendly. Donald Trump wanting to slap lots of tariffs on things may help some industries, but of course hurt other industries that rely on exports. So, and the Democrats, raising taxes on corporations, how do you do that without, producing layoffs? Corporations will say we can't afford it. So I think the complexity of the global economy makes it very difficult for parties to have a uniform or consistent message on this point.
Wendy Schiller of Brown University, wonderful insight as always. Really appreciate it. Thanks so much, Wendy. I've got to say, the idea of what kind of economic proposals we're actually hearing is hard enough to pin down, let alone what the potential consequences might be.
Also, by design, if you look at a lot of the reporting, what the Harris campaign is trying to do is have these broad ideas, these ideas of opportunity and change, get the excitement of the base, but very skim on the details.
At the same time, it seems like that's the reason why stock markets aren't sure how to handle all of this. Bond markets are sure, which is that essentially there is a lot of spending and not a lot of cost cutting. The U.S. Treasury spent $861 billion on net interest in the national debt over the 12 months through the July, double 2 years earlier. And it would be $100 billion more if you added in some Fed interest payments, and it's set to double yet again. You wonder when this starts to get some more attention.
And perhaps it is if we have an election and you do have both a Democrat in the Oval Office and a unified Democrat Congress. Maybe that's when we start to get worried and say these proposals may be thin on details, but maybe they can actually get passed.
They get worried when the 10-year auction comes in and it's very disruptive and there isn't necessarily the base of primary dealers to take it down and cushion it all. But, maybe I'm biased. Coming up next, former U.S. Ambassador to the United Nations, John Bolton, on tensions in the Middle East. Right now, markets struggling to eke out a seventh day of gains, but things can change. This is Bloomberg. what a wild ride. Just to put this into perspective, we just had the biggest 6-day winning streak going back to November 2022 after the biggest spike in volatility since the height of the pandemic. Right now, welcome back. This is Bloomberg Surveillance. We are struggling to really eke out a 7th straight day of gains, a mild kind of pause as we see S&P futures lower by about 0.1%, still about 2% away from all-time highs reached last month, 55.60. NASDAQ also meandering, but still that outperformance, Danny, squarely on the Russell 2000, up 0.2%, even with this idea that the economy is resilient and maybe on the margins it could pressure the Fed to cut less.
Right. Goldilocks, potentially, I'll say her name out loud, Goldilocks, potentially, because you do have maybe not as big of Fed cuts as we wanted, but some semblance and an economy that's doing well. But I still go back to what Lisa Shallett said yesterday, that there are some companies that are not good in the Russell 2000. So how many people here are trying to make a macro play or just buying up the index level without realizing that the quality of companies in the Russell 2000 has been declining year over year as private equity hoovers up a lot of the good lasting ones?
In the meantime, this really does come down to what happens with the Fed. They allow this kind of cycle to continue. And we did get this piece from Bill Dudley, former New York Fed president, out, which is really interesting. Right now we're seeing in the bond market yields continuing to be quiet, heading downward after yesterday, rising on the 2-year up some 13 to 16 basis points, actually at the biggest potential sell-off, with yields spiking, now down about 5 basis points, 4.04%. 10-year yields also lower a similar amount, 30-year yields also lower. But yesterday we saw this surge because of a resilient economy at the same time that you're still hearing Austin Goolsbee talking, Anne-Marie, about the idea that they want to get ahead of any kind of downturn. That is exactly what Bill Dudley is talking about. At Jackson Hole, will we hear this Federal Reserve shift to have a more preemptive policy stance?
Potentially, if the Fed is ready to cut in September, Jackson Hole is the moment for Jay Powell to really insinuate that. Ed Yardeni, who'll be coming up with us a little bit later, talked about the fact that he thinks the Fed needs to go one and done. And he says the debate now is not September, November, December. It's 25 basis points or 50 basis points.
And the question will be, what does this mean for the foreign exchange currency transmission mechanism? A lot of people are saying this would mean a weaker dollar, which is the reason why people were bailing out of the weak yen carry trade. They appear to be going back into it, which has been something that people are talking about in terms of maybe you do see a dollar continuing to strengthen on robust growth. Today it is not cooperating. So that is seeing a bit of a decline, 148 on the dollar yen cross. Under surveillance this morning, Vice President Kamala Harris will propose offering $25,000 to first-time homeowners as part of her economic policy rollout today. More than 1 million home buyers who have a 2-year history of on-time rent payments would be eligible for the benefit. A real question here about the feasibility of this getting passed, Anne-Marie.
Well, she needs congressional support to get this passed. And Wendy, Schiller was just talking about how basically this is an economic pipe dream at the moment. But it does play to the concerns you are seeing with voters, not just higher grocery prices, which they discussed yesterday with this idea that the blame is not us or just the economics of the time coming out of the pandemic. It's actually price gouging from corporations, a ton of pushback on that. But the fact of the matter is, when you look at the inflation report yesterday, what was that biggest component? It was housing. Inflation rates are high right now. Mortgage rates are high right now. So they're trying to tap into that. But again, I think it's going to be very slim on the details.
What do you think happens to prices if you give people more money to spend on them? I'm just saying. Meanwhile, talking about price gouging, Kroger planning to lower grocery prices by $1 billion if its merger with Albertson materializes in a bid to appease the regulators. That doubles the company's previous commitment of $500 million in cuts at Albertson's locations. On one hand, Danny, you have the question about antitrust and pushback. On the other, you have a question about just how high inflation actually has or has not been within the food space. A report coming out on Wednesday showing that grocery prices in July were up only 1% from a year earlier.
So there's this really funny conversation happening online that I see basically on every social media channel right now where people are saying, oh, my grocery bills have doubled. And people have said, no, they're not. What are you talking about? They have not doubled. They are slowly growing. But it goes to the point of this is so high in the voters' minds. You have proposals for Kamala Harris to stop price gouging. If that's the case, can we realistically think that Kamala Harris and Alina Khan FTC is going to let this merger go through? Even if they're proposing that they'll slash $1 billion in costs, it's so difficult to track. They have so many different branches, so many different products that it's hard to kind of keep grocery stores honest on pledges like this.
Well, Yeah, and it's very difficult to know exactly what the rhetoric is going to be now versus the actual policy, considering the fact that potentially it might be more amenable. I will just say this is the reason why you've had just sort of frozen M&A markets with a lot of companies real skeptical of really spending real money on a deal that may or may not transpire. Meanwhile, Gaza peace talks underway in the Middle East between Israel and international mediators. Axios reporting some progress was made on the first day of discussions, citing U.S. officials. This coming as Israel braces for a possible attack from Iran. Joining us now is Ambassador John Bolton, former U.S. National Security Advisor and former ambassador to the UN. Ambassador Bolton, thank you so much for being with us. I want to start with what you think of the recent talks underway and why you think Iran has not retaliated yet.
Well, with respect to the talks, the administration saying making progress, they've been saying making progress on these talks for about 4 or 5 months now. They never seem to get to the finish line. I think there are still enormous gaps between the Israeli position and the Hamas position. I'm not saying a miracle couldn't happen. It happens in the Middle East from time to time, but I wouldn't look for it. I do think Iran has hesitated to retaliate for the killing of Ismail Haniyeh, the Hamas leader in Tehran. They need to strike back, I think, very strongly. They've been humiliated by what Israel did, killing this terrorist leader in their capital, in a secure compound, with a bomb planted 2 months before. It shows nobody in Iran is safe from Israel, including the supreme leader. On the other hand, the Iranian leaders are also intimidated by Bibi Netanyahu and Israel. I think this time they are worried that the U.S. will not be able to pressure Israel into a limited response, as Israel did after the 320 drone and missile assault on Israel from Iran's territory some months ago. Really, Iran is more intimidated by Israel than it is by the Biden administration. So they've got a difficult decision, how strong a response to make to restore their own very damaged credibility versus their fear of what Israel would then do to them.
Well, in April, when those 300 missiles were flying over, it was because of the U.S. defense that Israel was able to fend them off. And Ambassador, given your level of intel regarding Iran, how can they retaliate but also try to not strike this cycle of endless retaliations back and forth?
Well, let's come back to the April attack. Wall Street Journal and CBS reported that of the 120 ballistic missiles that Iran fired at Israel, 60 never made it within range to be shot down. They either blew up on the launch pad or crashed before they got close enough, which speaks to the quality of Iran's ballistic missile force. But if there had been 120 rather than 60 ballistic missiles in the skies over Israel, I don't think it would have been such a good performance. The cycle that's at work here is caused by Iran. Look, this is not a war between Palestinians or Gazans and Israel. This is a war by Iran against Israel, what they themselves call the Ring of Fire strategy. And as long as the current regime in Tehran is in power, seeking nuclear weapons, arming, equipping, training, financing, giving intelligence to multiple terrorist groups in the region, threatening not only Israel but the Gulf Arab states too, there's going to be conflict. And what's driving Israel and the Gulf Arabs closer together is they all see Iran as the main strategic threat, and they think the United States is feckless.
As these ceasefire talks continue, do you agree with the idea that Iran could potentially use those, if they were to ink a deal, use that as an off-ramp to not retaliate?
Well, they may want to use it as an off-ramp, but I think it would be a big blow to Iran's prestige. They're not exactly stepping up here to take responsibility for what happened to Hamas after the October 7 attack. And they've also not been able yet to persuade Hezbollah to use its unbelievably large arsenal of missiles against Israel. So, as I say, I think it's the fear of further Israeli retaliation that has the Iranians intimidated.
With that retaliation coming from Israel, if Iran does do some sort of large attack, Ambassador Bolton, what is the ability of the U.S. and its allies to rein in Netanyahu's response?
Well, I'm sure that the Biden administration will want to rein them in. They've been afraid of this issue and the war in Ukraine dominating the news in the United States because it shows a world in chaos due to 3.5 years of American weakness. Really, what they would like to see is this go away until after Election Day, even though Biden's no longer running himself. You know, frankly, I think the lesson to be learned is that the prospect of a really forceful Israeli response, if Israel comes back at them, shows that a strong posture toward these rogue states is the way to go. And Iran has a lot to fear from Israel. It should have a lot to fear from the United States, but at the moment it doesn't.
And Ambassador, a lot of times when we're talking about this retaliation, even if Iran would like to do that without provoking a response, the question always comes into the fore: what is the likelihood that mistakes are made? Mistakes are made that escalate things further. And that there's been this conversation that it won't just be Iran this time, but Hezbollah as well. Are the odds for mistakes higher by involving proxy forces in the retaliation to the retaliation to the retaliation?
Well, look, I think you have to look at what the strategic picture is. There is a regional war in the Middle East now of Iran against Israel on 5 fronts. Hezbollah from Lebanon, Hamas in the Gaza Strip, the Houthis that have closed the Suez Canal, Red Sea passage, one of the most important commercial shipping channels in the world, closed effectively since October. The Shia militia in Iraq and Syria that have been attacking American positions, and Iran itself. And the question is, how do they dial up one or the other? Israel does fear Hezbollah's arsenal, which in public estimates, this is an extraordinary number, but public estimates are that Hezbollah has between 120 and 150,000 missiles, which would obviously be enough to overwhelm Israel's air defenses, and leads to the question, if they really think it's about to happen, might not Israel strike first? It's complicated. It's not mistakes. It's the fact that the leadership in Tehran is determined to destroy the little Satan. That's what's at work here.
Ambassador Bolton, yesterday we heard from former President Donald Trump, who you worked for. He said, I'm not looking to be bad to Iran. We're going to be friendly, I hope, with Iran. Maybe, but maybe not. But we're going to be friendly, I hope. We're going to be friendly. Do you know what Trump 2.0's policy towards Iran potentially will look like?
Look, he has no idea what it will look like. People who look at what happened in the first term and believe that it'll be the same in the second term, I think are mistaken. It's always possible. But remember, Trump almost met with Iran's then Foreign Minister, Javad Zarif, at the Biarritz G7 summit in August of 2019. Emmanuel Macron, the president of France, had Zarif in a villa in Biarritz, almost persuaded Trump to do it. The attraction to Donald Trump of making a deal with anybody is hard to quantify. It really goes off the charts. And it could be the same way in a second term. And that's why I think there's a certain amount of pressure on the Israelis, if they're going to do something, to do it now rather than to wait for the uncertainty of the American election.
Ambassador John Bolton, thank you so much for taking the time with us today. Right now, let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahira Haque. Yahira.
Hi, Lisa. Bayer shares are rising after the German company scored a legal win surrounding its Roundup weed killer. A customer had sued over the product's warning label, arguing it should have warned about cancer risks, though Bayer has insisted the product is safe. An appeals court found that case supersedes state law and needs further legal review. The ruling is a much-needed win for the company, which has seen shares fall 49% in the past year and more than 70% since acquiring Monsanto in 2018. Meanwhile, Texas Instruments will become the latest U.S. tech company to get a boost from the Biden administration. The chip maker is set to receive $1.6 billion in CHIPS Act grants and $3 billion in loans. The funding will help pay for one semiconductor factory in Utah and 2 in Texas, which will be built through the end of the decade. U.S. officials have now allocated most of the CHIP Act's funding with more than a dozen awards. They expect to wrap up announcements by the end of this year. And Citibank is being accused of failing to properly compensate its bankers for meal breaks, rest breaks, and pre-shift work. A proposed class and collective case accuses the company of violating the Federal Fair Labor Standards Act as well as the labor laws of at least 48 U.S. states and Washington, D.C. The bankers brought their case in the U.S. District Court for the Southern District of New York and are seeking unpaid wages and punitive damages. According to the complaint, Citibank began failing to pay the bankers for all hours worked as early as 2018. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the resilient consumer.
Coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient. And it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative.
That's coming up next. If you don't have a clear sense from the ping pong we've been playing, don't worry, it'll probably change by next week. This is Bloomberg Surveillance. Remember that stress of last week? Yeah, neither do I. Right now, you're seeing pretty much a calm in markets after the biggest six-day rally going back to 2022, declining about 0.1%. What I find interesting is that yields continue to go lower, even with the prospect of a resilient U.S. economy. The idea of preemptive Federal Reserve rate cuts coming squarely into focus. 10-year yields 3.87%, down about 5 basis points. This all comes down to how much Americans are buying. Under surveillance this morning, the resilient consumer.
Coming in and seeing a positive print in retail sales suggests that the consumer is actually pretty resilient. And it's a sign that maybe some of the things that we endured last week and some of the volatility is still not that clear of a narrative. So we've seen a massive shift from focus on inflation to focus on the economy. And I think that's where sort of every data point seems to matter to the market.
And whipsawed in turn. Here's the latest. Traders paring back bets for a supersized September rate cut, now expecting fewer than 100 points of easing this year after stronger than expected retail sales and jobless claims data. Winnie, Cisar of CreditSights writing this. We are encouraged to see the repricing of Fed cutting expectations as the jumbo cuts priced in immediately after the July jobs report were far overdone. Winnie joins us now. Winnie, before getting into just sort of the details of just how many cuts and when they're going to cut in a supersized jumbo cut, I'm just wondering whether you endorse this idea of a preemptive rate cutting cycle that can stave off weakness that currently is nowhere in the pricing in frankly, credit or in stocks.
Good morning, Lisa. Well, we have been saying that the Fed should try to be more proactive in this rate cutting cycle. It was something that they tried to do in 2019 with some, quote, insurance rate cuts to continue the expansion in the economy. And we did hear Fed Chair Powell discuss that topic pretty explicitly at the last Fed meeting. But there is much stickier inflation in the pipeline in this cycle than there has been in recent memory. And so that does leave the Fed in a pretty challenging position. But we do think that some proactive rate cuts probably make sense at this point.
This makes a really important difference for particularly high yield credit, because these are the companies that are most akin to the Russell 2000 in credit land. And they're the companies that have more leverage and have higher yields and are going to be more susceptible to both a weaker economy as well as potentially borrowing costs going down. So how do you see sort of the success of the Fed's ability to preempt some kind of weakness? How do you see how it's being priced in markets and whether that reflects reality?
Well, right now within the corporate credit markets, there's a pretty significant dispersion across valuations. You have pretty tight spreads and I would say objectively good yields for a lot of the double B and single B universe. And then on the other side, you have the triple C world, which is trading kind of near distressed territory in aggregate, still a wide range of valuations there. So investors are definitely taking a close look at these more leveraged capital structures that have higher vulnerability to sort of economic deceleration amid elevated borrowing costs and saying, these are probably not sustainable over the long term, which means we think that there is going to be a default rate that is, above the pandemic lows for maybe an extended amount of time as some of those defaults work through the system. But it doesn't mean high yield in aggregate is a necessarily bad place to be right now.
Winnie, there is this criticism that part of the reason you don't see some of those risks reflected as much as they should is just because of an imbalance. There's just so much demand right now compared to what supply is. And then private credit, the argument goes, is also a distorting thing. Is risk distorted at this moment?
I would say that risk is not necessarily distorted, but technicals have been absolutely driving valuations. And that is just the supply and demand balance. Right now, with fixed income yields at 5% for investment grade, 7.5% for high yield, those are historically very attractive places to get involved in corporate credit. And that is pushing a lot of capital into fixed income and into credit. And at the same time, fundamentals have been good enough for credit. We have definitely seen some erosion, some deterioration as it relates to leverage coming down, interest coverage coming down. But in general, the numbers are still okay. No one is expecting this massive downgrade cycle. And so people are kind of balancing that and seeing the technicals being so strong, feeling a little bit okay with where spreads are.
So that's the demand side of it, Winnie, and why that remains strong. As to supply, what we have seen, most of it has been refinancing. What level of Fed cuts do you need to see to really reawaken deal activity?
Well, it's been interesting because we've seen a lot of deal activity this year, but as you've noted, the bulk of it has gone to refinancing. I think there are a number of other factors weighing on the broader M&A and LBO environment outside of just the interest rate side of things. I think that if we had more certainty around what the regulatory environment was going to look like in the next political regime, what the actual economic outlook was, do we have a true consumer deceleration? Is growth going to slow down significantly, or are we going to stay at 2% GDP? And also some relief on the borrowing cost side of things, then I think that a lot of companies would be a little bit more willing to pursue some pretty transformative acquisitions. But we're just not in that place right now with the uncertainty around regulatory, the economy, and also borrowing costs.
This is kind of, I guess, a difficult question, Winnie. But when we talk about easing financial conditions and easing monetary policy, hasn't it effectively already been eased for a lot of these companies? In other words, if the Fed cuts by 100 basis points, let's say, even that much, will that actually change the backdrop for companies that are already enjoying rates that price that in proactively?
So this is an interesting nuance within the financial conditions conversation. Borrowing costs are still elevated across the world of corporate credit. When we see new issue deals priced in investment grade or high yield, they're pricing at coupon levels that we haven't seen, in a decade, given how low yields got in the post-GFC and then COVID era. And so there has been a pretty significant repricing of the cost of debt, which I would argue is, a little bit more tight financial conditions. But execution has been strong. Companies have not had to really worry about, by and large, going to market and not actually having people come and buy the debt that they're issuing. And oftentimes companies will look at that execution and the ability to have access to the capital markets as a pretty constructive sign overall. So I think that the financial conditions and easing, that conversation is a little bit more nuanced. Just then companies can come to market.
Which is especially the reason why also, how much will the Fed affect change by actually engaging with rate cuts versus just confirm what already has been baked into markets? Winnie Cisar of CreditSights, thank you so much for being with us. As always, honestly, I'm looking at the Bloomberg Financial Conditions Index, and Danny, you can actually see it getting easier over time, not tighter, which really highlights how it sort of raises this question about how effective the Fed is with actual policy versus just simply forward-looking rhetoric.
And you could even argue that the last policy decision, having Powell come out and sounding a bit more dovish than his last policy conference, was enough to kind of inject not full cuts, but some level of verbal cuts. And you also see that in mortgage rates coming down slightly enough where you have the most people coming back in for mortgage applications and sometimes surging 17%. So you can see some of the pockets of the easing starting to play out. And then you couple that with people calling for 50 basis points of cuts. What environment would that actually put us in?
Well, especially because we're already pricing that in. That is the issue. That is effectively what this market already has baked in the cake. Coming up next hour, Dale Cronk of Wells Fargo, Jen Bartashis of Bloomberg Intelligence as we look back on Walmart and some of the other retail earnings and data. Betsey Stevenson of the University of Michigan and Ed Yardeni of Yardeni Research. This is Bloomberg Surveillance.
Aggregate profits look great, but it's really just a couple of sectors that are driving it.
Sentiment did get a little bit dented around large cap tech earnings.
Some of that negative correlation to equities is coming back.
Our view is that a soft landing backdrop is good for a broad swath of companies.
I think this is more of an unwind than a momentum flush. The low volatility period is behind us.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Last week was Armageddon. This week was Goldilocks. On to next week, which will just come up in a couple days. Good morning. Welcome back. This is Bloomberg Surveillance. Anne-Marie Hordern, Danny Berger. I'm Lisa Abramowitz. Jonathan Ferro will be back on Monday. Right now, we're looking at markets struggling to eke out a seventh day of gains. A real question now, Danny, as the focus goes not just to the data, the economic data and the earnings, but to the Federal Reserve, the symposium in Jackson Hole, and to politics.
It does, because we have this dearth of things for the next 2 weeks. So that kind of has to be it. Still in the late summer trading markets where we've learned what can happen during it. But to your point, it is a market that just keeps swinging back and forth between extremes. And really one of the most successful trade in bond markets has been to fade those extremes. Fade the 6 rates cuts priced in at the start of the year. Fade no rate cuts. Fade again the 100 basis points of cuts priced in. We just keep going back and forth.
It's a seesaw of basically fading moves, but a lack of conviction. And this really raises the issue of the volatility introduced by politics. Anne-Marie, I love that we ask people about politics. They say, we don't like to talk about politics. We don't think it matters that much. We think that probably markets trade independent long term. And then they say it is the number one question from all of their clients every single time they have a conversation.
Yeah, so the strategy when you hear from some of our guests is this is just noisy, look through it. But then it's like, oh, okay, so what are your clients asking you about? Oh, this is the number one issue they have, and they want to prepare themselves for it. I think what's interesting about this week is because inflation, to many of the Fed speak, seems to be that they're feeling like they're getting it a little bit more under control. But inflation is the big driver for this election. And we're going to see, we have seen that through the policies that both sides are trying to come out and talk about. Paul Donovan, I loved his note this morning. The U.S. presidential election may be won or lost in the aisles of Walmart. That's how close food inflation, things like that, are going to be tracking these voters.
Well, all I know is that Walmart had just a fine time in terms of the food aisles, in terms of its stores. And I think that that's part of the issue, part of the tension, Danny, right now. Whether bonds and stocks are sending the same message, because at a certain time, bond markets are allowing for a pretty aggressive path for the Fed. At the same time, the stock markets are expecting this resilience to continue. How important is next week's discussion by the Federal Reserve, by Fed Chair Jay Powell, on the preemptive actions of a central bank that wants to avoid the traditional hard landing that happens almost every time there's a rate hiking cycle of this size?
Well, it will make a difference to the whole debate of 25 versus 50, because presumably if you're going 50, it's because something is wrong, that you are too late and you need to catch up. If it is preemptive rather, 25 certainly makes sense on that point. But the bond market keeps overdoing this. It's like Schrodinger's recession, and the bond market thinks the cat's dead, and every time we get data and look inside the box, it's actually alive. And so the Fed maybe needs to kind of thread this and say, we're not going because we're falling off of a cliff. We are going because we're trying to prevent that.
I just have this image now of a box with a cat, and then, of
know,
course, it's Friday, and so everyone can go look at cat videos. Right now, we're looking at markets that are mildly negative, basically range-bound, trying to find direction after having the head spinning kind of experience of the past 2 weeks. What we're seeing right now, S&P futures still about 2% away from all-time highs reached last month, 55.58. If you take a look, you've got euro strength, and this to me is actually one of the more interesting stories of the past few weeks. Have we started to see the euro breakout, or more importantly, the dollar more consistently weaken versus other currencies? DXY really seems to highlight that trend, which goes counter to what so many people said about the U.S. economy being exceptional. And 10-year yields lower today, 3.86. What I find curious is how much do people, as they start to talk about politics, really bring back the deficit discussion that so many people say, okay, this tired old thing, it never will come to markets until it does. Does that start to sort of percolate up a little bit more? Coming up this hour, Dale Cronk of Wells Fargo with stocks on track for their best week of the year. Former Labor Department Chief Economist Betsey Stevenson on what recent data means for the Federal Reserve. And Ed Yardeni of Yardeni Research on why he's still in the one-and-done September rate camp, an increasingly out-of-consensus call as the market prices in potentially 4 rate cuts through the end of this year. Let's begin with the top story. The Goldilocks scenario is back on the table and fully embraced. Stocks rallying on strong U.S. retail and labor data, indicating continued economic strength. Darrell Cronk of Wells Fargo remaining cautious, saying this: the U.S. economy is slowing and the Fed should be cutting interest rates. They probably should have already cut in July. The burden of proof has now switched over in the market's eyes and is on the soft landing to prove itself. Darrell joins us now. Darrell, did you write this before this past week's data?
I did not. I actually wrote it yesterday morning. I think outside of markets' kind of vicious reaction last week and this, if you kind of double click below the surface, there is disconnects here, right? The yield curve is disconnected. I think some of the consumer data is disconnected. We read, retail sales yesterday up 1%. That was, almost 6/10 of it was autos, right? The rest of it was food, beverage, which is stuff we all have to consume every day. So it wasn't like discretionary spend, right? It wasn't some big, element that showed that the consumers out there spending crazily, right, on this. And I think there's disconnect in the manufacturing data and the housing data. We got the National Association of Home Builders yesterday. Think about it this way: that came in at a 39. Right, anything below 50s, means that their outlook is poor for home builders. And yet home builder stocks are going crazy, right? I mean, they're up, setting new, basically all-time highs. So you've got all these disconnects that I think markets have to reconcile themselves with.
Let's talk about one particular disconnect in the bond market, where you have parts of the bond market talking about an economy that is in need of a lot of Fed support, and then you have other parts of the bond market that are suggesting that this is an economy that's quite robust. How do you understand and reconcile some of these discrepancies?
Well, I think you put it well earlier, right? Think about it this way. I wake up in the morning and the first thing I look at is the 2-year Treasury, right? Quickly, generally now, last couple of weeks, followed by the Japanese yen, right? Those are the 2 eyes-on elements. The 2-year Treasury at 4 to 4.25 does not sync with 9 interest rate cuts between now and next year, right? The math just doesn't work. I mean, the Fed funds is a 5.25. You bring it down to, let's say, 4, that's 125 basis points of cuts. We have 100 priced in for this year alone, much less what we're going to do in 2025, according to the Fed. So we're right back into this camp of who's right, who's wrong. Is the yield curve right and the 2-year Treasury right at 4 to 4.25 and maybe grinding higher? Or, are we going to get 9 interest rate cuts? We've seen this movie before. We didn't believe it at the beginning of this year on the 6 interest rate cuts, right? We said that would get walked back. We didn't believe it at the beginning of 2023 when the Fed funds futures priced in 3 interest rate cuts for the back half of 2023. Third time's a charm. There's no doubt the Fed will go in September. I just don't believe the 7 to 9. And if you get 7 to 9, it's a problem for the economy. That's the reason we're cutting that aggressively, right? It's not because we're soft landing this thing and we need 9 interest rate cuts to get back to our start.
I wonder what you make of duration and the level of the 10-year right now. We were having this discussion earlier with State Street, this idea that you're living in a time where the soft landing seems probable, at least for now. We're not falling off a cliff at the very least. This week. We'll talk again next week.
Yes.
And in the meantime, you have these policy proposals coming from candidates that seem to indicate a lot of spending. And you have fears about auctions and auctions that have tailed, yet it is a 10-year that is still below 4%. Mm-hmm. Does that make sense?
I don't think it makes sense. I do think the long-term kind of neutral rate of the 10-year is around 375 to 380, not very different from today. But just last week on the volatility, we had been, like most people, kind of crowded on the short side of the curve in our exposure and positioning. We basically took that positioning and we bulleted it, right? Not barbell. So in other words, we took money out of the long side, took money out of the short side, and went right to the belly of the curve. Because we think you're getting good value there. You do have to start biting in duration and take some exposure there if the Fed is going to cut interest rates, which we believe they will. We just maybe fade this idea that they're going to be able to cut as aggressively as what everybody else does. So you do have to go after some duration here. You can't just live on the short side of the curve, or you're going to get killed with reinvestment risk over the next 12 to 18 months.
Back to the fiscal policy outlook, though. Is the bond market just ignoring all these policy proposals?
For the time, yes. I mean, if you went, so if you take my neutral rate on the 10-year at 380, and then you regardless of the candidate, right? The two things that I think are certainties post-November are, bigger federal budgets and fiscal spending and more tariffs, right? Those are the two things you can bank on, regardless of whether you get, Harris or Trump. And both of those put an upward bias into interest rates, all else equal, right? So I think you're going to see this continued, fight, these kind of 2 sigma moves in yields on a daily basis that we haven't seen in maybe careers of a lot of bond traders and people who manage money. But it may be the new norm. The volatility may now exist fully in the fixed income markets and not as much in the equity markets as we just keep the carry trade in the short vol, and we just drive the VIX down into, from 65 to 15, and we push the yen back weaker again, right? It's just, we're carrying on right now.
It sure feels like we're seeing a lot of once in a career events just in the past 2 weeks. One of them being the yen, which you said you wake up in the morning and check. What does it tell you when you wake up on a day like yesterday after the US data and you see dollar yen up 1 1/3% after just, again, 2 weeks ago, a week ago rather, about a week and a half, we saw this huge appreciation in the yen, that we can get that firepower back with dollar yen?
Yeah, I think it's, last week was all about kind of vicious unwinds of the yen carry and the short vol leveraged trade, right? They're putting it right back on this week, right? I mean, and putting it on with a vengeance. And it's coming from the buyers, they're shorting the yen and they're shorting the vol or VIX, using that capital to go out and buy risk-on assets, right? And it's coming from all sources. It's coming from the hedge fund community, it's coming from institutions, it's coming from retail, it's coming from buyback programs that now we're getting to the end of Q2. Companies are using any weakness to aggressively step in with their buyback programs. So it's coming from all corners, and until you change that and you couple it with kind of August seasonal low liquidity, and it creates these outsized moves.
Let's just take a step back for a second. You said the volatility may now exist fully in the bond market, almost more so than in the stock market. Has it affected the way that you position, where suddenly stocks become more of the haven trade and bonds become more of a trading game, sort of the sort of daily grind that you think of with day trading of stocks, not traditionally bonds?
Yeah, some of the worst performing returns at the asset class level were in the fixed income markets this year, right? Maybe up until about last week. But the Barclays Agg, which is your common domestic indice, is one of the few indices that still hasn't set a new all-time high. Everything else is pushing, all-time highs across the board, and the Barclays Agg has not given you much return over the last few years. People get enamored with the idea of I can now get 4, 5, 6%, on the short side of the curve. But when you actually get to a total return, it's pretty anemic and it's pretty bad. So it's pushed people to equities as kind of there is no other alternative, right? The TINA trade, and they just keep going back to that as a way to get exposure until you can't or don't, right? Until volatility spikes.
Is that how you're arranging things? Are you buying into the TINA and staying away from big risk in bonds?
No, I would say we're a little more balanced. So we used last week's weakness that we bought into small caps, right? When the Russell 2 came all the way down to 2,000, had a 10% full correction. We bought into high yield because we thought, at 380, 385 on high yield spreads, that was the highest or widest spreads of the year, right? That we finally got a chance to take a bite at some high yield in that environment. And then we moved out duration on the fixed income market. So, but overall, I think from equities to fixed income, we're slightly overweight equities, but nothing where you've pushed risk budgets or positioning out to extremes at this point. And I think that'd be a mistake, to be honest, at this point.
Well, we can get into why in a bit. Darrell Cronk, always wonderful to speak with you. Thank you so much for being with us. Darrell Cronk of Wells Fargo. Right now, let's get you an update on stories elsewhere this morning. Haque is here with your Bloomberg Brief. Yahaira.
Hi, Lisa. Kroger is planning to slash grocery prices by $1 billion if its merger with Albertsons goes through. That's double what it previously pledged to cut at Albertsons stores. Kroger agreed to acquire its rival Albertsons back in October 2022. The nearly $25 billion merger is an effort by Kroger to compete against the likes of Amazon and Walmart. Resorts World Las Vegas has been accused of catering to individuals with ties to organized crime. The Nevada Gaming Control Board has filed a complaint alleging that the property welcomed people with suspected or even actual ties to illegal bookmaking and histories of federal felony convictions. Resort World is owned by Malaysia-based Genting Group. And Bloomberg has learned that Seagram heir Edgar Bronfman Jr. is close to making an offer for Paramount Global. setting off a potential bidding war for the entertainment company. Sources say Bronfman is weighing an offer for the controlling company of Paramount, National Amusements, as well as Paramount itself. Remember, Paramount agreed to merge with Skydance back in July, but Bronfman's group is framing its proposal as a better deal for investors because it won't include the dilution associated with the Skydance merger. That's your Bloomberg Brief. Lisa?
Thank you so much, Yahira. Up next, the morning calls, plus more insight into the consumer with earnings from Target and Macy's still ahead. We already got Walmart, and that was pretty much a boon for the consumer. That's coming up next. This is Bloomberg Surveillance. The bulk of the earnings are over, although we do have a few key ones coming up. Time now for the morning calls. First up, Williams trading double, upgrading Nike to buy from sell. The analyst saying the athletic giant is on the right path after rehiring longtime executive Tom Petty to focus on retail partnerships. Next up, JP Morgan raising its price target on BJ's wholesale to $76, keeping an underweight rating. The analyst noting that forecasts are essentially unchanged, while second quarter estimates will likely get a boost from gas profitability. And finally, Bank of America raising its price target on Walmart to $85, keeping a buy rating. The analyst highlighting strong second quarter earnings and higher margin profit streams, helping to offset some mixed sales headwinds. The big box retailer seeing its grocery and health and wellness categories outpacing other general merchandise, as Walmart lifts its full year outlook on the back of consumer spending for necessities. Investors waiting to see what next week's retail results bring. Joining us now to talk about those retail results, as well as what we've seen so far, is Jennifer Bertashis of Bloomberg Intelligence. I guess that really the key question is going to be heading into next week with Target and some others. There's an issue of how much Walmart speaks to consumer resilience and how much Walmart is a story unto itself.
That's an excellent point. I mean, Walmart generally has its own dynamics. And when we look forward to Target next week, one of the things to keep in mind is that a year ago in second quarter is when they had the backlash from all of the boycotts that consumers had from their Pride merchandise a year ago. And so they do have easier comparisons, so that's a great setup for Target. But they still skew to more discretionary spending. And so it will be interesting to see how well they've attracted consumers in to buy more of those essentials through price reductions and advertising and things like that.
Jennifer, what do you make of whether the consumer is strong or whether the consumer is weak? You have retail sales that highlighted the fastest pace of expansion going back almost a year. At the same time, Darrell Cronk was just on talking about how the bulk of that was in auto sectors. And honestly, we are seeing a lot more pushback and desire for value. So, Jennifer, where are we in this?
Well, I think across the board, the consumer's not getting worse, but they're not getting better as fast as probably most people would like. And that's really reinforcing that search for value. With regards to current spending, we are in the middle of back to school. So we are seeing consumers spending a little bit more for school supplies and things they need to get their kids back to school, back to college. But that spending could actually extend a little bit longer throughout this current quarter than most people expect. Just as people buy things a little bit closer to when they need them versus stocking up ahead of time.
Jennifer, I was really interested by what Walmart CEO had to say about AI in their call. He said that they use generative AI to create or improve 850 million pieces of data in the catalog. They say without generative AI, they would have needed 100 times the workforce that they currently have to get that work done in the same amount of time. It's been easy to kind of make fun of all these missed attempts at trying to use AI for some of these consumer companies. But is Walmart onto something here? Are these companies finally finding a way to adopt AI for efficiency?
I think that this is a great example of where generative AI can be a real boon to a business. And if you think about the chase of Walmart trying to catch Amazon, it's technology like generative AI that will actually allow them to close that gap more quickly. Instead of having to hire labor and people and going through kind of that arduous process of cataloging things, AI can really unleash potential there. And so I think this is a great example where it's been used in a thoughtful manner, and it's a way that's helped them accelerate their business.
Jennifer, we do see inflation somewhat still biting some individuals, especially when you look at Home Depot, their report, where it talks about people are deferring some of these big projects. There's a lot of noise coming from Washington, this blame game. Do you see anything closely remote to price gouging right now when it comes to retailers?
Well, on the staple side, when you're talking about food and groceries, we have seen prices come down a little bit. One of the things that Walmart did talk about on their earnings call earlier this week is just that about half of their suppliers are engaging in trying to lower prices. About half are still saying they might want to pass through further small price increases. But it is a hot topic. I mean, we're hearing from the campaign trail that prices need to come down. The unfortunate thing is that it's just not as simple as that. We've got costs that carry through an entire supply chain. So I think there'll be a lot of scrutiny on the packaged food manufacturers on the staple side, and how retailers can help control those costs to make things as affordable as possible for consumers.
We're speaking with Jennifer Bertashis of Bloomberg Intelligence after getting retail sales that came in yesterday at the fastest pace in more than a year, after getting Walmart earnings that were incredibly robust relative to even expectations when you look under the line items, maybe not in the overall projections. And then when we've been speaking to one travel executive after another about how, particularly in higher income brackets, people keep on spending. Jennifer, how much are we seeing any deterioration whatsoever in higher income bracket spending at a time where that has been one of the big drivers of overall consumer appetite, just when you look at aggregate numbers, albeit maybe not just the average rank and file household?
Well, we're not really seeing deterioration in the higher income spending. What we're seeing instead is a slight shift in where and how they're spending. And so I think they're being more thoughtful about their expenditures, but that's not necessarily changing the full amount that they're spending. And so we still see people prioritizing travel. We still see people prioritizing things that are experiential in nature. Those things, we think are going to continue. And that should, add a little bit of, resiliency to the overall consumer spending. But we're really not seeing much of a pullback on the high income side.
Jennifer Bertashis of Bloomberg Intelligence, thank you. And that sounds consistent with what we heard from the likes of cruise liners as well as luxury resorts and hotels. I have to say, this really is going to be one of the key challenges for the Federal Reserve next week at Jackson Hole. How do you deal with the fact that you've got lower income consumers that are highly stretched, that are really feeling the effects of high rates, at the same time that overall consumer spending, Amory, just has not fallen off because of the ability for higher income consumers to spend?
We continuously hear about this bifurcated economy, but the Fed has two levers really only to deal with it, one economy, and that's the inflation side of the mandate and the job side of the mandate. Incredibly difficult moment for them because the higher end consumer is spending, and they're spending a lot more on all of these items, even if they're trading in once in a while for some deals when it comes to Walmart.
Which also speaks to this question that Bill Dudley rose, which was very interesting to me, Danny, because we haven't heard that much of it recently. Should the inflation target be higher? Will they allow a wider band in terms of inflation in order to allow for some equalizing on the bottom line? It becomes a tricky kind of push-pull because on one hand, inflation is the biggest tax on lower income individuals. On the other hand, high rates are the biggest tax on the lower income segment. So you're kind of stuck between a rock and a hard place.
Well, it comes back to the reason you're doing it is a preemptive rate cut, which Bill Dudley also argues for in that piece. Because even if the data is strong, even if upper income households are still spending a lot, there are still pockets of weakness that you can point to. And Neil Dutta and the team at Red Mac point out this, that you might have really good retail sales, but take-home pay was lower last month. And at some point, it's got to stop. The music needs to stop. It can't just keep happening indefinitely as people spend all of their savings.
What can keep happening indefinitely is an incredible amount of volatility. Last week was all downbeat. This week is all we're dealing with potential Goldilocks. The 6 straight days of gains left the S&P more than 6% higher. The NASDAQ more than 8% higher. Coming up next, breaking housing starts data. Former Labor Department chief economist Betsey Stevenson here to react alongside Ed Yardeni of Yardeni Research. From New York, this is Bloomberg. was the way an August week should be, essentially pretty calm, if anything, very positive and happy. Everyone getting ready for a 2-weeker before they head back after Labor Day. Right now in markets, you could see a bit of a turn, a little bit of a decline softening after that 6-day rally with S&P futures lower now by 0.3%. We also see in the bond market a bid in with yields lower ahead of that Fed symposium in Jackson Hole, led by the 2-year. Right now we're getting some housing data. Michael McKee with us here, Bloomberg Economics and Policy correspondent. What do we got?
Bad news on the housing standpoint, because housing starts fall by 6.8%. The forecast was for a 1.5% decline. Last month, they grew by 3%. Building permits also down by 4% after a 3.9% gain in June. The forecast was for 2%. So it looks like at this point that builders are not confident in their ability to either sell these houses or to get them built. If you look at the charts for the number of houses under construction, they've come way down at a time when they're having trouble finding construction workers. So that may be part of it. But also affordability is difficult, and it's just not a good housing situation. And I know, Anne Marie's all over this. This is more of a political issue at the moment than even an economic issue, because everybody is upset that they can't buy houses.
Well, yeah, and especially if there's a younger generation that has no affordability or no entry point into the housing market. Just quickly, actually, the response in markets is notable. You're seeing some of the declines extend in the equity market ahead of the open. In bond markets, you see yields go even lower. It does seem like maybe on a quiet summer Friday, people are just trading on anything, and if it's a slight bit negative, you get the sort of knee-jerk, bad for stocks and good for bonds. It does raise this question, though, Mike, about how much of this really does reflect a housing market that is stuck in two very difficult places. On one hand, you have the idea that it is getting more costly and difficult to build houses and less optimism there. On the other, affordability is really low considering how high rates are and the inflexibility of people to actually move.
Yeah, the Fed is going to be lowering interest rates, and that will help with mortgage rates, but mortgage rates won't go down to the 2s anymore or the 3s. The mortgage people did a survey this week that said people aren't really going to start refinancing or taking out new mortgages till we get to 5 or below. So that'll take a little while. And then the primary issue is we don't have enough houses. There aren't enough houses to buy, and there aren't enough houses being built. And so from a political standpoint, the candidates want to talk about ways to get more houses built. That's going to be the major issue.
Well, it's one of these things of how is this cycle different from other cycles? And previously, when mortgage rates came down, you did see housing prices come down because there was enough supply and people could get to them. Of course, the supply picture isn't there. And realistically, how do you do that at a time when housing builders don't want to build houses because they're not sure the demand is going to be there?
It is difficult. They know the demand is going to be there. I think it's a question of when the demand is there. And if the builders don't want to be stuck with inventory that they had to work off. They did that for the last couple of years because they went into the COVID era building a lot of houses. And then all of a sudden, people wanted to move. And they built more houses, and then people stopped moving because COVID kind of went away. And now we're at a situation where there's, in a couple of years, a lot of property coming online. Not enough, but a lot coming online. And around the country, not in New York City, but around the country, that depresses prices.
With the sentiment yesterday being downbeat in the housing market and the data today, is it surprising? Because everyone is expecting the Fed to cut rates. Shouldn't it be moving in a better direction?
Well, you could argue that, but at this point, people aren't seeing it. I mean, rates have come down quite a bit. We're in, 6.5 down from 7 and still moving
people
lower.
Are refinancing.
And there is a slight move towards refinancing, but there aren't a lot of people who have rates that are that high that they can refinance. And what we're basically living through here in terms of affordability is the consequences of having low rates for so long. Mortgage rates went down so far that everybody refinanced or got new mortgages at very, very low rates. And why do you want to move? And that clogs up the housing market.
Michael McKee, stay close. Thank you so much for being with us, and we will be with you in ample time next week at that Fed symposium. I'm so pleased to say, joining us now, former Labor Department Chief Economist Betsey Stevenson, also a Bloomberg Opinion columnist. Betsey, wonderful to see you. Thank you for being with us. We're going to get into what we can expect for Jackson Hole next week, but before we go there, I'd love your reaction to some of the housing conundrum that is increasingly percolating itself into policy proposals, putting aside what's actually been proposed, which a lot of people said is not going to see the light of day. What do you think is an appropriate policy reaction to try to create a more even playing field in the housing market?
You know, I think that there are a couple of things that really need to be done. And so you can actually listen today when Kamala Harris gives her speech about housing, whether she addresses these. But one of the things we have to do is just get housing built faster. And that's going to mean cutting through some of the red tape. You know, everybody really wants to make sure that only certain kinds of housing goes up around them. All of this not in my backyard type policy. And you have communities that really slow down the process of building housing. We want to, we really need to speed that up. We need to make it easier and cheaper. And we're also, we need to make sure that there are the incentives in the system for building affordable housing. And so we're looking for making sure that there are policies in place that are really trying to put their thumb on the scale to give builders the incentive to want to build something that is affordable. And then the third thing I think we really are going to have to address is what I call mortgage portability. We have people locked in to mortgages that are under 4%. We're not going to see that again for a long time. And they're stuck in their houses. They're baby boomers stuck in big houses that need to downsize, but they can't afford to downsize because they'd give up a really affordable mortgage. What we could do is make it so they could take their mortgage to the next house to try to get rid of some of this mortgage lock. Because if we don't do something to address the mortgage lock, I think we're going to be stuck with that for quite some time.
Wow, this was something that was actually done in the 1980s in a certain way to allow people to have some portability. Is this something that you're actually hearing anything concrete about?
That idea of mortgage portability is, I'm just going to say very clearly, not something I'm hearing concretely coming from any of the campaigns. I think what you'll hear more about from Vice President Harris are ways to incentivize the building of more housing and making sure that housing isn't becoming more of an investment commodity by big corporations that buy up lots of housing and push the prices up. That's one of the concerns you've seen out of the whole Biden-Harris administration is the corporatization of certain sectors and how that affects affordability for everyday Americans. But the end of the day, I think what you just asked about, what do we do about mortgages? I think that's got to be part of it because the Fed is not going to cut rates enough that you're going to be able to go back to those locked-in mortgages that many people, including myself, have with a 30-year mortgage locked under 3%. I don't want to go anywhere. I don't need to go anywhere, but I know people who really should downsize, and they've done the math, and they literally pay more to buy a house that it costs, half as much because of how it would change their mortgage rate. I do think that's a policy issue that I'd really like to see addressed by Vice President Harris at some point.
Betsey, to your point, though, that's not the conversation right now. The conversation, or at least the proposal that we're likely to hear today, is give $25,000 to 1.4 million new homeowners and try to get 3 million, incentivized via taxes, 3 million new homes to come onto the market. I know the likelihood of that actually coming to fruition is one conversation, but I want you to just take that proposal at face value. How successful will that be at achieving some of the things that you're talking about without creating distortions in the market?
There's a lot of families that don't have the seed money, the down payment necessary to make a purchase. And it's become harder to come up with that down payment because you're just spending your 20s and 30s paying your student loan debt. And then you might want to have kids. And then you've got the very, very high cost of early childhood education, of daycare. When and how are you supposed to save up to be able to put a down payment down? So I think she wants to address that problem. Of course, what economists would say is, well, wait a minute, if we hand out more money to a housing market with pretty fixed supply, Do you know who gets that money? The people who own the houses. And so you have to, if you're going to do a policy like that, it's absolutely essential that it gets paired with expanding the supply. Otherwise, literally all the money just gets captured by the people who already own the housing. So I do think that there are some reasonable policies in there to try to expand the supply of housing. I agree with you to say, like, look, you've got to get all this stuff passed. You've got to get the tax credits being proposed passed. You've got to get some of the red tape that's being proposed being actually cut. And some of that red tape is not at the federal level. Most of it is actually at the local level. So how do we get local communities to do that? I will tell you that New Zealand had one of the highest housing price crises, I think. And it's very confusing. New Zealand, they got plenty of land. Why are their houses so expensive? And what they did was they cut the red tape, cut it substantially, and they saw housing prices actually come down. So it is possible to do it. Building more housing is always the answer. It always works. The question is, can we actually get those incentives into the system, passed into law, and make sure that we get the expansion that's necessary to to actually get what they're claiming we'll get, which is more housing and therefore cheaper housing.
Betsey, the Biden-Harris world want to be viewed as the competent camp, although their proposals, people are saying, are pie in the sky, and frankly, some of them wouldn't even work, like price gouging. Then why aren't they talking about things that you're talking about, like cutting red tape?
So, first of all, I think they are talking about cutting red tape. And, junk fees was a big issue for the Biden administration. And I think that was one that was particularly close to Vice President Harris's heart. And, that's not government red tape, but that's a different form of red tape, right? We're all confused about the prices because somewhere in, some fine print beneath what you're buying, it says, oh, by the way, it's actually another $40 for this hotel room because we didn't tell you about this extra fee, or for this flight, or, for all sorts of things. So I think they understand that Americans want simplicity, and simplicity requires cutting red tape. It requires eliminating junk fees. It requires making sure that, that the market's operating fairly. On price gouging, when I first saw that, I'm like, oh, okay, yeah, we all roll our eyes and say, oh, we can't fix prices. But, at the same time, telling businesses that they need to slow their roll and they don't need to be jumping prices by large amounts at a time, that's not necessarily going to be bad. And I think particularly with the limits on rent increases, it makes a lot of sense. If you're sitting there and you get a notice that says your rent's going up 50% in a month or 2 months, you might not have a plan. You might literally find yourself on the street, because how do you come up with that kind of money that quickly? So making sure that, no one needs to raise rent that fast. We have a lot of forward looking. We're watching here right now. We're learning all about the economy. We can form expectations about what's coming, and we can make a good plan that allows there to be slow price increases. Price gouging has always been against the law. And I think what you're hearing is, can we do a better job of enforcing it? But I will agree with you that there are trade-offs, right? When we say, no, if you're a hardware store with shovels stocked and a big snowstorm's coming in and you triple the price of those shovels, you'll get it, but it's a jerk move. And at the same time, what might happen is somebody who decides, maybe I want a second shovel in case one of my kids wants to help out, buys the shovel because the prices didn't go up, and then their neighbor doesn't get any. Right. So those are the trade-offs, right? And what they're saying is, I think we've leaned a little bit too hard on the price gouging end, and let's try to get some balance back in this market.
Former Labor Department Chief Economist Betsey Stevenson, thank you so much for taking the time. We really appreciate it. So that's the policy and the potential kind of ramifications. Really important to get a sense of where we are now in terms of the economic strength, especially heading into Jackson Hole next week. Joining us now, Ed Yardeni of Yardeni Research. And Ed, I just want to start there. I mean, there are a lot of proposals for how to make things better and to bring down inflation. How much is the Fed going to respond to the weaker side of things, or how much is the Fed going to respond to the strength and the resilience in sort of not needing them to have to cut too far?
Well, between now and the next meeting in September, we're going to get an employment number. And I think that employment report that we will get in early September, and that'll be for August, will reverse some of the weakness that we saw in July, which I think was to a large extent weather related. And if that's the case, that'll be one reason for the Fed not to do 50, but to do 25 basis point cut in the federal funds rate. In addition, we'll get a couple more inflation numbers between now and that meeting, and they should continue to confirm that inflation has moderated. So I think it all points out to 25 basis points, not some of the hysterical talk about needing 50 to 75 basis points, which we saw last week.
And why can't I make the argument, though, that going at 50 makes sense because we're so far away from the neutral rate that just doing 50 means that you just get closer to that. It's not something like an emergency cut, but it's just to get back to not being so restrictive.
Yeah. Well, I'm not a big fan of the neutral rate because it's a fantasy. Nobody knows exactly what it is. You can't measure it. You can't see it. There are people who use statistical models to try to estimate it, and it always seems to be changing. I think at the end of the day, we just have to see how the economy is actually responding to where interest rates actually are. And I think that the Fed has actually normalized interest rates where they are currently. The economy is performing fine. There are clearly pockets of weakness in the economy. I call them rolling recessions. But overall, the economy has grown by over 2%. In the second quarter, on a year-over-year basis, it grew by over 3%, which is kind of a normal growth rate for the economy. So why mess with success? The big risk in lowering interest rates aggressively is that you get a stock market melt up. And the consequences of that is we then might be following it with a stock market meltdown. And I don't think we need to have those kind of excessive moves in the financial markets triggered by the Fed being a little bit trigger happy in terms of lowering interest rates.
Ed, if they do a cut and it's a big one, say 50 basis points, would that not signal to the market, though, potentially the Fed knows something, the market does not, and actually the economic conditions are deteriorating faster than people are expecting?
Yeah, absolutely. And by the way, it was only a week ago that there was all this talk about needing 50 to 75 basis points. If the Fed actually had on an emergency basis lowered interest rates, so that would have worsened the crisis, because a lot of that was the unwinding of the carry trade that was going on a global basis when the yen was too strong. So if we lower our interest rates by more than necessary, and meanwhile the Japanese economy is looking pretty strong, and they go back to raising rates, we're going to get another carry trade unwind, which was pretty scary last week. So I think these central bankers have to be careful with the power that they have.
And I got to say, you are the one who really coined roaring 20s. You've been bullish on U.S. equities for a long time. Your biggest flaw just hasn't been maybe being bullish enough in terms of having to upgrade your forecast. So now the question is, do I hear a sense of change from you, that you're getting more cautious now ahead of a sort of, I don't know, threading a needle that seems like it's maybe not being threaded in the right way?
No, a few weeks ago, I raised my number for the S&P 500 from 5,400 to 5,800 by the end of the year. I still feel pretty comfortable with that. I just don't want to see us significantly exceed that, because I think that's melt up kind of territory. Already valuation multiples are really quite high. But honestly, we've achieved a lot of what I expected we'd achieve this year. I wouldn't mind if things just kind of simmer down a little bit. And I think they will. I think, we still have a presidential election up ahead here. We still have a lot of geopolitical risk, though oil prices are down a lot this morning. But I think by year end, we'll have another solid rally that'll probably take us up to 5,800, new record high.
Do you think, Ed, that we could see that 5,800 target achieved even with bond markets selling off in akin to basically what you're calling for, which would just be one rate cut? Currently, it's much more getting priced in.
Well, that's right. But I think the trade-off is going to be that the reason for the bond yield coming down of late, at least until recently, the weakness in the stock market was a perception the economy was weak. I think we're going to see that the economy is actually doing just fine in coming weeks. So I don't really have a problem with the bond market continuing to be somewhere between 3.5% and 4% for a while. But I think the economy can withstand 4.5%.
Ed Yardeni of Yardeni Research. Always wonderful to speak with you. Thank you so much.
Thank
and have
you.
a wonderful weekend. Up next, setting you up for the week ahead, this is Bloomberg. Almost there, counting you down to the opening bell for the last trading day of the week. Here is the trading diary for the day and week ahead. At 10 a.m., we'll get University of Michigan sentiment. And around 1 p.m., Fed speak from Chicago's Goolsbee, who was speaking earlier this morning with NPR. At 2:45, Kamala Harris delivering campaign remarks focusing on her economic agenda. We will bring that to you on Monday. This is when it all begins for the Democratic National Convention in Chicago. President Biden set to deliver an opening speech on Tuesday. Earnings from Lowe's and Toll Brothers. Wednesday, we'll get Target, Macy's, and TJX earnings before the opening bell. And Fed minutes coming out at 2 p.m. Thursday, the Jackson Hole Economic Symposium kicks off, plus another round of jobless claims. It's a lot to get through. S&P U.S. PMIs also on Friday. Fed Chair Jay Powell delivering those key remarks. Danny, in that panoply of potential events, what are you most focused on?
It has to be Jackson Hole. And the thing I'm most interested in is not necessarily what Powell says, but what everyone else around him says. Because we've started to see this coalescing of FOMC committee members who are saying the time is right, that the risk is not going soon enough. The risk is waiting too late. And I say it's most interesting to hear everybody because of the conversation we had with Steve Rasciuto earlier this week, that because it's September, because we're heading into an election, they can't be seen as political in delivering a cut. And in order to not seem political, they need to have everybody in agreement that now is the time to cut.
I guess that Jackson Hole probably is what you're watching too, Anne Marie.
No, I'm going to be in Chicago at the DNC, although I'll have one eye potentially on Jackson Hole to see what Jay Powell says. Because to Danny's point, it really is going to be potentially, through the eyes of some, they're going to look at this through a political lens, whether or not they go 25, 50 or cut at all when it comes in September, especially from the Republicans. We've already heard that from the former President Donald Trump, that they shouldn't cut ahead of an election. When it comes to the DNC, for me, it's really what happens after the DNC. Of course, there's going to be a tremendous amount of excitement and momentum at the DNC as they basically coronate Kamala Harris as the Democratic candidate, hopeful for them that they want her to be president. But what happens after? And we actually have to see her sit down across from a journalist, not at rallies, and answer questions and details about these policies that they're throwing out.
All I can say is, and please forgive my skepticism, I hate saying this, but at what point can we take any policies, either from the Harris camp or the Trump camp, as anything serious, if none of them are going to see the light in the day and all of them are trying to pander to a particular constituent?
Well, I think you have to take what Darrell said pretty seriously, which is that fiscal policy is going to expand whether or not we have a Republican or Democrat. What they spend on, what they prioritize is going to be different. But also that will only matter when we know what the composition of Congress is going to be. And then also tariffs. Regardless of who wins, some level of tariffs will be in play.
Which raises the question about bond market volatility. To me, this is what I'm watching. How volatile are bond markets? Because all of these events disproportionately affect bonds than they do stocks. How much are we looking, Danny, at an asset class that has a volatility that has traditionally been the haven, stable, steady as she goes type of securities?
And how especially vulnerable are we that we all just loaded back up into bonds? The JP Morgan survey showed the most net long on the Treasury market for the year so far. What happens when we maybe start to believe some of these policy agendas saying there is going to be a lot of spending, and does below 4% on the 10-year make sense?
Coming up on Monday, Lori Calvasina of RBC, Kelsey Barrett Darrell of JP Morgan, Jim Caron of Morgan Stanley, and Mike Schumacher of Wells Fargo. Have a wonderful weekend. We'll see you next week. This was Bloomberg Surveillance.
Huge upsets on day 4 at the Cincinnati Open. Defending champion Coco Gauff is packing her bags after she went out to Yulia Putintseva in the second round. The American was far from her best on center court after losing the opening set 6-4. Gauff leveled the match but collapsed at the end of the deciding set. And don't forget, Tennis Channel's live coverage from Cincinnati hits the air daily at 11 a.m. Eastern.